As you can see here, we have multiple awards. You can see just 2024, we had the best broker in LATAM, which is Central and South America, the best affiliate program. This year, we won the most innovative broker award, and the list continues. Now, to speak a little bit about our products, we do have many different instruments that you can trade. The most popular instruments, of course, would be the volatility indices. Everyone knows us for VIX, but we do have regular Forex. I know that some persons use two different brokers, one for VIX and one for Forex. We actually have all in one. So you can trade gold, you can trade USD, JPY, anything that you want to trade, still using just us. We do also have crypto. So just in case, you can take a look at some of the other options that we have available so that you can trade just under one umbrella. Now, this is the end of my quick presentation, and I will look at the chat now for questions.
Okay, guys, so let us begin with the sweet stuff, what you guys have all been waiting for, the charts. So before we actually even begin talking about the charts, the most important thing I want all you guys to understand is, as much as the media might flaunt trading as something that is easy or easy money, it is not. It takes work, a lot of work, and it takes risk. I saw someone commented they fear losing. And if you fear losing, you fear winning as well. It requires risk. And the more you take risk, it becomes easier, but you also want to grow. So you have to condition your mind that in trading, you have to take risk, take calculated risk. Because if you ask me, anybody can trade. But the hard part is the mental aspect, the risk management aspect. That is where persons fail. That is why I try to simplify the charts, the trading, as simple as possible, so you as a trader can focus on the important stuff, which is the mental aspect. Knowing that, hey, risking too much account on a single trade are going to lead into bankruptcy. It will. So you might see somebody do a flip today and congratulate them, right? Job well done, because it takes skill to spot a proper trade. But at the same time, doing something like that is not sustainable, right? You need slow, consistent, calculated growth. So when I hear we say, okay, how much are the risk per trade? The risk between 1 to 5% maximum per trade, right? And one of the biggest things I see persons asking for nowadays is account management. And let me tell you guys, it is something that is very risky. Why I can say that is because when you are trading your own money, it is very difficult. Imagine trading someone else's money. So I always say, if you do not have the time to learn the skill yourself, it is not for you. You're gonna always have problems because it is not that straightforward, right? Trading involves work. You have to put in the work on your end, right? So I can be here keeping class every day, teaching you guys everything we need, but if you don't put in work, it doesn't make any sense, because you can't learn everything by just watching videos. You have to put in the hard hands-on work, right? What that means is you have to go up on the chart. So on the screen, this is the derivative chart, the trading view, right? And this is where you basically go to work, right? All your tools, everything is right here. Cool. On the right side, you have a watch list with all the popular quotes, right? You have Forex, you have crypto, I have the VIX. Cool. You can edit this as much as you want. You can add the ones that you want, or you can clear it off. So let's say we create a new watch list for today. Let's make a new watch list for today. Create new list. New. All right. So I'm gonna make a new watch list. So it's now empty. So I'm gonna now add, let's say, VIX 10 to this watch list. I'm gonna search for VIX 10, or you can just click on derived, and you will see all the VIX pairs, all of them, right? So here's the first thing I want you guys to know and understand. These markets are synthetic markets, right? They simulate robotic price movements. Cool. So each of these markets have a different characteristic, right? So let's say VIX 15 1S. VIX 15 1S is a slower moving pair than, let's say, VIX 100 or VIX 75. So the rule of thumb for me is the lower the number, the slower it is. The bigger the number, the faster it is, right? So for a beginner, I recommend trading the slower pairs because the volatile pairs will stop you out and give you a headache, right? So take it slow and focus on the slower moving pairs so you can build confidence and build up your trust in yourself and in your skills, right? So you're gonna jump on, let's say, VIX 15 1S. The first thing you will see on any charts is you will see some shapes. Some might be red, some might be green, they might be different colors depending on what chart you're using. But these shapes are what's known as candlesticks, right? They basically illustrate price movement. So this is basically a graph. It's a graph. It's like when you have a school, you plot the graph, you have the x-axis and you have the y-axis. So on one axis, you have price. And on the other one, you have time and date, right? So basically, you realize that the chart is basically a graph that plots the price of an asset against time. That's all. So basically, I show you where an asset do over the span of, let's say, 15 minutes, 10 minutes, a hour, 4 hours. That is where time frames come into play, right? So, I know most of you guys might hear about the time frame. You have the daily time frame, you have the 4 hour time frame, you have the 1 hour, the 30-minute time frame, the 10-minute, the 5-minute, the 50-minute, the 1 minute. What that basically means is each of these candlesticks represents that specific time. So right now, as you can see, I am on the 24 hours time frame. What that means is each of these candlesticks represents 24 hours, right? So right away, you can look at this and realize, oh, so basically, this time frame is showing the historic price movement of VIX 25 per day for the past couple of days, right? So let's actually zoom in and further analyze the candlesticks to learn more, right? So looking at it, it looks exactly like a candlestick in real life, where I have the wick, then I have the body part, right? The wicks, them basically represent the highest and the lowest point of a candlestick. So I'm going to draw a candlestick and show you guys the different parts of it and how a candlestick moves. Cool. So this is a candlestick right now. This is a candlestick. Let's say this is a bearish candlestick. So bear mean down, bull mean up. Cool. Bear mean sells, bull mean buys. All right. So this is a bearish candlestick, and this is the body part of it. So the candlestick have some basic parts. Once you understand these basic parts, it is easy for you to identify what the market is doing, pretty much. So once you know how to read the candlesticks, you know how to read the market, right? So if this is a bearish candlestick, And as I said earlier, bear mean down. It means that this candlestick over the span of a day should basically decrease in price or represent a decrease in price movement. So if price was, let's say, at 10 today, tomorrow, same time, it's maybe at, let's say, 5. So it show a downward movement. So we are going to label this. We are going to label this. Where is the brush? All right, brush. All right. Give me a second, guys. Let me start out these tools and the cross here. Yeah. Okay, so let's say this is 10, right? The candlestick open at 10. And that is the open, because if it's going down, it have to start from a higher place to a lower place. So that is the open. Let me label it open. All right. All right. So that is where the market open or the candlestick open. All right. All right. Cool. That is the open. So if price open at 10 and price went down, as in decrease in value, it basically closed at a lower price, right? So that is basically what a candlestick do. It represents what the price do over a specific span of time, right? But then it doesn't end there, right? Because price can go lower and come back up before it close. It can do anything. So that is where the wick comes into play. The wick basically represents the highest and the lowest point that price went. So let's walk through the cycle of this candlestick so you guys can understand how the wicks come into play. Let's say at 12 a.m. today, the market open, right? This candlestick open and open at 10. And it is expected to close at 12 a.m. again tomorrow, right? And it closed lower, So let's say it close at 5, right? So what happened is during that 24 hours period, price not just open at 10 and just got 5 one time. No, it it fluctuates. It moves in pulses. So price may pull up above 10 and go to maybe like 12 or 13 and linger there for some minutes or some hours. Then price may come down lower than 5, right? Linger down here. So, and then now, maybe when it's closer to the time when the candlestick is supposed to close, the price might come back and then close at 5. So that's basically how a candlestick operates, or how a candlestick moves. It open, pull back into a direction. Let's say it can pull back in the opposite direction, or it can pull back within the direction. But one thing is almost always certain, each candlestick will give you a wick. So if we look on the charts, you realize that pretty much all of these candlesticks have both a top wick and a lower wick. What that basically means is, for instance, look at this current candlestick right now. Let's break down this current candlestick. For the persons who have questions and issues, I will get to you guys shortly. So let's say this candlestick, right? This current candlestick right now. Looking at it, you guys can realize that it's a bearish candlestick, right? It's red. It's a bearish candlestick. So it means downwards movement. If you look closely, you realize that price opened right here at this specific price, 2,790.91. That is where price opened. But if you realize you have a wick that goes all the way up to 2,808.00, right? What that means is price open here, but before it go down, it pulled back into the opposite direction before going down. So I want all you guys to let that sink in. And you will now realize that the market basically replicates real life stuff. For instance, The pullback of the candlestick is just like you going up a stairs, right? You go up, you go down, you go up, you go down, or even a catapult. It have a pullback before it goes forward, right? So the candlestick is the same thing. Before it move in a specific, before it move in a direction, it normally pull back before it moves, right? So by now, all you guys should understand the basics surrounding the candlestick, and I'll take it. Some of you guys may have questions, so I'm gonna go through now and answers the questions. So let's see what the questions are. All right, just raise your hand if you have any question. All right. All right, give me a minute. Let me allow you guys to unmute your microphone. Give me a few moments, guys. Let me figure out how I can individually unmute the persons who have their hands up. All right, so please ensure all your guys' microphones are muted. So the person who have the questions, I'm going to call your name. Just unmute your microphone and ask your question. All right, so the first person with their hand up is Sonita Allen. Go ahead. What is your question?
Hi, afternoon. Are you hearing me?
Yeah, I'm hearing it clearly. Afternoon.
Alright, so I understand what you're saying with the candlesticks and everything, but I was wondering if this session could be recorded, so if I wanted to go back and rewatch it, I could possibly do that.
Yes, I am currently recording the class. It's being
Okay,
recorded.
great, thank you.
All right, cool. All right, Lenroy Haven. Go ahead, bro.
Yeah, man, afternoon. So the
Afternoon.
question is in relation to the candlestick. So my
Yes.
observation is a 24-hour candlestick I just reviewed, right? So what me I like to know if the same explanation I give as it relates to the wick and the pullback and whatnot, is it the same for the 5 minute
Same
or
on all time frames, bro.
10 minute, same way?
Same, same everything on all time frames. So the only thing
Okay.
different between the time frames is the time itself. So the difference between the 1 hour and the 2 hour is on the 1 hour, each candlestick represents 1 hour of price movement. On the 2 hour, one candlestick represents 2 hours of price movement. But it's the same concept across the board.
Okay, much respect.
Yeah. All right. So next person. All right, Lamar, go ahead, bro. See your hand up.
Yeah, afternoon. What influences the length of the wicks, whether high or low?
Very good question, bro. Very good question. So, what influence the length of the wick is basically volatility, right? So, whenever you have high amount of volatility in the market, and before before I explain that, let me explain what is volatility. Volatility is basically volume, right? It's volume, the amount of influence in the market, the amount of sellers and buyers who are actively in the market. That influences the volume, the volatility, right? So the more volume is in the market, the more volatility there is. So that is why you may have peers that are more volatile than others. So earlier we said that the periods with the smallest numbers tend to have lower volume, lower volatility. The bigger number ones have higher volume, higher volatility, right? So what that basically mean is that will influence the size of the wicks and the candlestick body. So for instance, if you look on the charts, you will see you have candlesticks that are big, some of them are small, some of them are medium size. The size vary a lot. What that basically I tell you, it measure the volatility. So when you see one big red candlestick, it means that there are a lot of sellers in the market, a lot of sell value in the market, right? When you have a big green one, you have a lot of buyers in the market. So the wicks now basically come like when sellers and buyers are play tug of war. Because watch, remember that. Remember, say we basically would get the wick when let's say the market is going down, right? We have a bear candlestick going down. But before it go down, it push up, means the buyers would push the price up in our upwards manner, right? Because they might try to push the price in their favor. But then sellers weren't having it and decide say, no, no, no. We are push back the price down. So when you have the big long wick, them it a tell you say the sellers and buyers them are oppose each other. And the direction where it goes in a last would dictate who has more strength in that moment. Let me show you what I'm talking about. So, for instance, look at this candlestick right here with this long wick. Let me circle it. This bullish candlestick, the green one, this is it. If you realize it has a very long wick on the lower side of the candlestick, what that basically means is when the candlestick open, it open right here, so because remember, a bullish candlestick open lower and a bearish one opens higher. So it opened right here, right? What happened was price pushed down all the way down here, so. But then the buyers came in and pushed the price all the way back up and closed above the open, giving you a bullish candlestick with a long wick. So basically, The wicks and the candlestick body, I tell you one whole story. So just you have to understand now how to interpret it and how to read it. So the long wicks, I tell you say there's volume in the market, or there is volume coming into the market. So I hope that explain the question, bro. Clear enough?
Yeah, man, thanks.
All right. So let me answer a few more questions before proceeding to the plan. So the persons who don't have them name, I can't unmute you without a proper name. All right, Lamar go a while ago. All right, Philip, go ahead, bro.
Hi, good afternoon, everybody.
Blessings.
Yeah, man, thanks. So my question is, I have, so I'm pretty familiar with the derivative charts, and candlesticks is one form that the chart can be looked at. But as you probably know already from the boss, so you can change the candlestick to like line chart or some other type of bars. So I was trying using some of them like the Fibonacci because it give you online auto traders say it give you a smoother view of the chart, but I still wasn't for whatever reason, we still couldn't manage to match out the thing and make some profit. So I would want to ask you, I feel like you're going to focus on candlestick, but I want to know if you think that should be the only way we look at the chart, or do you recommend, like, depending on the time frame, you look at the chart using a certain type of chart like the candlestick, but you probably use a line graph when you look on a higher time frame or what's not. You understand my question? I hope you understand what I'm saying.
Yeah, bro, I totally understand your question. And so I am open to trying new things as it relates to the markets. But here's where here's what I realize, because I have always been trying new things. I've been through almost every different method of trading, and it was something that held me back for a long time, because I was constantly changing my strategy. I was constantly changing my approach, and I wasn't making any headway. I knew a lot, but no whole heap, but it doesn't translate into profits and being consistent. Because this week me I trade, all right, I'm not sure if any of you guys on the class remember from maybe like 2021, 22, them time there, where like every couple of months me have one new formula. So it's like a series. I have formula 1.0, formula 2.0, where me I evolve my trading skills, but at the same time, me get lost in doing that, where me I, every day me I try something new, me I try one different approach, and what that do is me no master nothing. You get me? Jack of all trades is no master. Me no master nothing. I must say no. There is a whole lot of information about trading on the internet, a whole lot of it. Every day one new technique and one new name form for the same things, right? What you need to do is you just need to keep it simple, right? Focus on what works. You ever hear them say don't reinvent the wheel? That apply to trading like crazy. Don't reinvent the wheel. Just like earlier I said, I don't want you guys to waste time trying to beat the market or trying to find the best strategy. You guys should be focusing on risk management, your psychology, and building consistency, discipline, and patience. So the charts, I believe you can have a simplistic approach to all the charts, and you can be profitable. All right, here's how I discovered that the technicals, it matters, but in a one way, it doesn't matter. Get a card, get a card pack, or even one kind, heads and tails, and flip the kind 10 times and simulate, say, each flip is a trade, and you have a win basically a 1 to 2 per winning trade and lose 1. So let's say you say I go win 20 US when you win, and lose $10 when you go lose. If you should do that over the span of 100 flips, I guarantee you will make profits. And that is a random occurring event. It is very random. Flipping it 10 times, you have a lesser chance of succeeding because the real mastery in trading is not one or two trades. It's sticking to the same thing over 100 or over 1,000 trades. The more trades you have, the more your odds increase. Remember, you know, guys, the market, one person don't control the market. The market don't have feelings. So if you are trying to beat something when you have feelings, with feelings and interpretations and how you feel, you lose in the battle. So my approach to the charts, bro, is a very simple approach. I'm not reinvent the wheel, but at the same time, I am doing something that is statistically proven over time. So if you guys realize, I am emphasizing a lot on the candlestick wicks because, to be honest, the only thing you need to understand about the charts is just the candlesticks, the wicks, and understand support and resistance levels. That's all you need to understand, nothing else. So if you have prior experience or prior knowledge about trading, keep it, keep it, keep it in your brain because it will help, but pretend like you're a sponge or a blank slate because trust me, 99% of what is on the internet, it works. It works, you know. I just you need to apply it. But guess what? Most of us can't stick to one thing too long. Because, for instance, this week haven't been the best week for me on the charts, to be honest, right? But I know that I have my weeks when time I am winning every single thing. For persons who are on the class from my free group know what I'm talking about. I have weeks when I'm winning almost every single trade. Then I may have a week when me no win no trade, worst case scenario. But guess what? For the month, I am net profitable because what? You don't make one single trade, one single day, or one single week dictate your results. The more time you have as a time is your edge over the market. Time is your edge. More trade is more edge over the market. So when you're approaching the market, think of it like how much trades can I take before blowing this account? For instance, if you want the best odds of growing 100 US account over time, is to divide that 100 US multiple times, right? Divide it multiple times. So you want to give yourself at least 15, 20 trades before your account blow. That is the approach I want you guys to have. So have an approach that is more mentally emphasized than technical. Even though the formula is very powerful, you guys will see the formula is very powerful. I mainly focus on the mental aspect, right? So I hope this kind of clear up the question we have, bro, as it relates to my approach to trying new things. You hear
Yes,
me?
yes. Yeah, stick to one thing. Be a master one thing than be a trader. Yeah, I get what
Exactly.
you're saying. Yes, I have many. Yes.
Exactly, bro. So I'm gonna proceed to the lesson now. So we went over candlesticks just now, right? We talk about the open and the close. Talk about the open, the close, the high and the low. So this is for a bearish candlestick. The bullish candlestick is basically the same thing but in reverse.
Yeah, but
Remember, bull mean up. Remember, guys, keep your microphone muted. No disturbance. Remember, bull mean up, right? We're going up. So price would open at a lower price. Look on the price scale on the screen. You will see it is now at 2739.9. Price push up, price there at 2786.7. That's a bullish candlestick. Put it in a blue. So what more you guys to understand is the candles can have any color, right? So train your eyes to be able to identify the candlesticks, whether these are black, white, gold, green, or the same color. So after I'm finished doing the bullish candlestick, I'm gonna do an exercise to see if you guys are following along. I'm going to turn all these candlesticks into black and pick a random person to identify if it's bullish or bearish. So remember, this is a bearish candlestick. It open, Open high, close low. This is a bullish one. Open low, close high. So let's label it. Open, that is the open, and then this is the close, right? So it will show a bullish movement. It will show a upwards movement. Oh, the open gone, open gone. Let me draw it back. A second. Open. All right, that is the open. And remember, the market not just open and close, open and close. It fluctuates. The market will create a low. So you have occasions, when there is no wick at the bottom or the top. And you have rare occasions where you have candlestick when you have no wick at all. But that is statistically less likely to happen. Cool. So this is the lower wick. Price went down all the way down here. So push up and come to a higher point and then close. So this is basically what a candlestick is. Open, close, low, high. That's all. Right? So I'm going to, and remember guys, all the candlesticks are connected. What that means is one close and open after another. So if you look on the charts, for instance, let's analyze this coming down. Right? We have this big bullish candlestick that push price from 29.23 all the way to 3,000, right? Then I have a bearish candlestick now. We're open because remember, as one close, one open. It's like a chain line effect, a domino effect. As one close, one open. As one close, one open. So you have one open from 3,000 down to 29.69, right? And perfect. Look at this. Look at this small green bullish candlestick. You see it's small? Those small candlesticks represents low volatility, low volume, low movements. Normally, when you have that, it means the market or price is on a breather. It's taking a breather. It's deciding whether to go up or go down. It's stagnant. Really make no movement, right? It's stationary. So the small candlestick represents indecision. Cool. So you have a small candlestick with a very small movement. Then I have this bearish candlestick now that push from 2971 down to 2956. So you see how all the candlesticks are related. They come like family. So I'm going to turn off the color of the candlestick now. And I'm going to select a random person to identify whether it is a bullish or a bearish candlestick. So on a side note, you guys seen me using the platform, which is TradingView. So to customize or edit anything on the interface, you just right click and go on settings. Everything is fully laid out here. You just read and identify and play around. It come like a one new phone. Press every button. You're not gonna lose the money. Once your live account na connect, press every button. You're not lose no money at all. So I'm gonna turn the candlestick's body in a black. Everything in a black. Everything in a black now, guys. So I'm gonna pick a random person to identify the candlestick. All right. Let's see. Let's pick a random person. See some hands up, so I'm gonna pick somebody hand up in the air. All right, Javian Williams, go ahead. What's your question?
My question was from what me do and do. Sometimes I use the trend line.
Yeah.
The week. You can use the week same way to mark a zone out when you use a trend line.
Yes, you can. Yes, you can, bro. Yes, you can.
Okay.
So I'm gonna ask you the question now, because it seems you have experience. I'm still gonna ask you the question. Identify what is this candlestick right here. This in the middle. Identify whether it is a bullish or a bearish candlestick. You have 10 seconds. 9.
A bullish.
No, you're wrong. It's a bearish candlestick, bro.
Bear.
I just lose on laptop a while ago, I swear.
Yeah.
All right, so let me explain the candlestick to you now. Remember, I said earlier, every candlestick connected, right?
Yeah.
So what you should have done is I
Repeat the
circled the one in the
question.
middle, right? No, I'm saying what you should have done was I circled the one in the middle, right? And you shouldn't be looking back. Look back at the one before to identify whether it is a bullish or a bearish candlestick. So as you can see, this candlestick clearly is a bullish one. This one right here so is a bullish one because price open here and close here. And then this one beside it now, when we circle, if you realize it never go above the close of the previous candlestick, which means it go down and it closed down, say bearish, and then an extra hint, the one after it is a bullish candlestick, means it open lower and go higher. So when it opened down here, so it did not go down none at all. So what that basically means is looking at this is a bearish candlestick. So I know some of you guys might still not follow along. That is completely normal. This class is being recorded and you can rewatch it to understand because I understand to say some of the time it not click right away. But my aim is to show that all you guys get the aha moment there at the end of this class. Right? So that is the candlestick. I'm gonna go answer two more questions and then we're gonna move on to levels of support and resistance. So let me answer two more questions. All right. Nasha and Barnaby, go ahead.
Good day, good day.
Blessings, bro.
I want to ask you how to stay persistent in the market.
Wow. How to stay persistent. Give me some more detail about that question, bro. Go some more deeper. It broad. Give me a more deeper explanation.
Like win 20 today, lose 20 tomorrow.
Oh, all right. So basically, bro, you have to look on trading like a business because it is a business, right? I have to look on it logically. Statistically, you can't win every day, right? If you can't win every day, it means you shouldn't be trying to beat up yourself for win every trade, and you should be planning on the fact that you're not going to win every trade. So what I realize is 99% of the issues you guys will or are facing as a trader is stemming from risk management and psychology. What that means is, you see, when you're risking too much money, you're anxious figure trade. When you lose, you want to jump in and trade all over again, so you're going to lose more and more. Then you're going to blow all your money. Then you're going to eventually just give up. Right? So it's something that you have to make sure so you look for the root cause of the issue. So if you're not persistent on the market, maybe it's a issue as it relates to your risk management. Maybe you need to tone back your risk management so you can be trading at ease. Because what you guys should understand is this. Do not deposit 100 US thinking that next week you have to fire your boss. I learned that the hard way. Don't do that. If you deposit 100 US or anywhere between 100 to maybe 300 US, your aim from that account is to pay one bill. I know it might seem like it doesn't make no sense, but take me stupid advice. If I could look back and tell myself one thing, take it simple, take it slow. Don't try make it too fast. Because you're going to do madness. If you're depositing between 100 to 30 to 300 US, your aim is to pay one bill. If you can pay 2 or 3 bill out of it, excellent, because those months will come, those weeks will come. But I am giving you the raw minimum, the worst case scenario. Worst case scenario, for instance, if you know say a light bill at $10,000 and you deposit 200 US, You basically need to make 50% of your account for the month to pay one bill. And if you ask me, that is a win. That is more sustainable. That is a more consistent way to stay in the market. Because remember, your aim as a trader is to survive. It's not to beat the market. It's to survive. You can't beat the market in a one straight up battle. You have to beat the market over time. It's a planting. I don't know if all you guys watch Prison Break. It's a mind game, guys. The charts is a mind game. You can't beat the market one time, so like it's a boxing match. No, it's a mind game thing. You have to beat the market over time. So when you put in your two bills, tell yourself, say, me not try to flip this. Me I try survive in a market as long as possible to learn as long as possible because we all make mistakes. Even me make mistakes. I make mistakes. So if I am risking an amount and I can't afford to lose, when I make the mistakes, them are gonna be detrimental. My account are gonna blow. Understand? So you have to make sure and say, yeah, approach it with the right mindset. So if you deposit two bills and make your light bill money, you need to make 50% for the month. Right? While 50% may be somewhat very ambitious, it is possible. But if you're targeting that and you're looking at trading in that aspect, in that mindset, you will last longer than somebody who said they might try to flip two bills to 2,000 in one day or 2 days. No. It is a fancy. People drawn to that because persons drawn to account flips. I do account flips, but if you ask me, it is not sustainable. For instance, I can grow account from 220 US to let's say 500 or 1,000 or any amount. But then majority of the time, you have to lose it back. Why? Because the aggressive risk management we take for grow the account to that point, you can't use it going forward. And that is something that took me a long while to learn. Where even now, persons message me and say, yo, you can grow my account from $20 to like 2 bills, 3 bills. But as soon as I start go higher, me blow the account. And I can look back and remember exactly when that used to be my biggest issue. It wasn't to grow the account, it was being able to survive the waves of the market. So if you manage to flip an account from a small amount to a bigger amount, right? Because it is doable. It is not sustainable, but it is doable. The best way to sustain it or try to sustain it is by reducing your risk as you go along, right? Reducing your risk as you go along. So the trades and when you lose become less painful. So that is basically how you are going to be persistent on the market by having the right approach, which is a systematic approach and a percentage-based approach. Right? So I'm going to answer 2 more questions and then dive into support and resistance. All right. Let me see who for else and up.
Thank you for they could explain no better.
Blessings, bro. All right. Romario Clark, go ahead with a question.
All right. So afternoon, everybody. So I earlier mentioned, say, you don't change your strategy regardless of what the market conditions are. So
Yes.
how do you manage like during the consolidation phase? Because you have different quarters of trading, like quarter 3, when it's lower and all that. So like how you manage like when you're set up or your strategy is less favorable in the quarters.
Very good question, bro. Very, very good question. So basically, how me approach this whole thing is like this. Every strategy have, as you said before, have the lows and them highs. Every one of them, right? So what you have to do is you have to condition your mind towards that. For instance, what if tomorrow, starting the trading week, me I look and me not say anything were favorable in my strategy, I am not gonna take it. So me relying 100% on my strategy saves me from doing a lot of stuff.
Jaja, rough your foot.
Mute your microphone, bro. And the microphone's mute. As I was saying before, you basically have to have that level of trust in your strategy for know say, okay, when it's my time, it's my time. When it's not my time, it's not my time. For instance, let me show you something that I realized over my years of trading volatility index. You see, at the start of the year, my results aren't so good. I have good weeks. I have break-even weeks, losing weeks, but it's not the peak based on what I have realized over the patterns. During the summer, it's kind of break-even, good weeks here and there, but over time, it is good. You see, like the year end, at the year end, I realize like me catch a lot of good trades. I remember 1 November specifically. 1 November, we were doing a live trading class, and I won every single trade for that month when I lose one single trade, literally. And that is what happens on the year end for me based on my strategy. So based on the time that I've been trading it, I know say year end and normally the best time for me. But the smart thing to do is not take it for granted, because I believe that every market evolves over time. I strongly believe that every market evolves over time. So while you may have data to back up certain things like when and when your strategy works well, the market can change. Because to me, I feel like every year the market gets harder and harder to me, because I have a time when I have to just lock in and do some back testing to make certain say I am getting the same results that I have been getting with the formula. Follow, bro? Make sense?
Yeah, 100%.
Yeah, man. All right. So we're going to answer one more question and then dive into support and resistance. All right, go ahead, Michael Palmer. Siano.
Good day, good day. You hearing me?
Yeah, good day. I'm hearing you.
All right. So, I have a question pertaining to the 24-hour. I noticed
Yeah.
that there was a pullback, correct?
Yeah.
Yeah. But then I saw you went on the 4-hour time frame, and I noticed where the wick is, and there was a big bullish come down where the market was indecisive, and it came down. But then I noticed when there's a pullback, the wick, like it go above the previous wick, and it turns back down. Does it always respect that wick?
Good question, bro. And the answer is no. It doesn't always respect it like that. So the size or the length or where the market may pull back to, it's not random, but assume it's random. Right?
Okay.
You have levels where can guide you, but you can't pinpoint exactly where the market will pull back to. You can have an idea, and that is why you have entry and you have stop loss, where you can place an entry and put a stop loss above where you anticipate it not going to go. So you can't pinpoint exactly where the market will go, no matter how skilled we say we are. We can't pinpoint exactly where it will go. Make sense?
Yeah, well, we can have an idea. So, all right.
Can have an idea.
That's
So,
good.
yeah, bro. So, ensure all you guys' microphone are muted. We have a dive into levels, support, and resistance. Right? So, just like the name suggests, support, and you have resistance. When I think about support, you think about something holding something up. Right? So, right away, you can say support holds price up. Right? Resistance resists price from going higher. So support equal a floor, resistance is equal to a roof. So think about this. If you take a tennis ball and you throw it on the floor in your house, the floor hold the tennis ball above it. If you throw the ball on the roof, the roof, the ceiling, the resistance prevent it from going higher. That is basically how support and resistance is, right? So let me draw an example of support and resistance on the charts for you guys. So let me start with a support. This down here, as you can see, the candlesticks touch this blue line numerous times and change direction. That is basically a support. So it normally set like one V, or if you want to call it one U or one complete 360. Once market interact with a support, it now want to change direction, right? And a support can be used multiple times. If you realize the market interact with this level of support down here on numerous occasions, it came down and touched it down here, so went up back for a brief moment and came back, interact again. So you see where everything basically makes sense and add up. You see where it touched the support exactly to the T. But if you guys realize, the support is not just one price. Even though you might see me draw one line, it's not just one price. The support is a zone. Like the question we bro asked earlier about like the level. The support is not just one price. It's an overall zone, because you don't know exactly where your price is going to go or it will go. You can have an overall idea. But based on how I have evolved as a trader, I can now draw one line, but me understand, say, even though one line we have, it's an overall zone. It's not just one price. One line is one price, but it's an overall zone. I draw a line because it's more cleaner. But typically, persons normally draw like a box within the area to identify the zone. So you may draw it, let's say, interact with this wick up here, so, and it interact with the lowest point. So it's like it capture an average area. So we know that this average area is a support. So some persons have a lot of issues drawing the level of support and resistance. And I think you guys are overcomplicating it, right? So let me show you my cheat code in drawing levels of support and resistance. So for instance, down here, right away, I realize that the market interact with it a couple times. You have here so, and here so. You don't want the support to be too big. That is where judgment comes into play and practice and short time come into play. You develop a level of judgment over time that, to me, it can't be taught. For instance, as a new trader, you might draw this and things, say, yeah, man, the support are ideal, right? But then as you go along, and you gain more experience, you realize that this doesn't make no sense, right? And then having a support where too tiny, you draw one line. So it's like there is a average size where you stick within. So normally what we do is, you know, I draw support from here, but try to capture all I touches them. So I want to capture this one in here, so which is not the highest one, and this one. So what I might do is I just drag it from here and bring it across. But I know say it capture the highest one and also the lowest one. So may I look on this over here, so which is the highest on the levels them, and then this which is the lowest one. But you have occasions where the highest and the lowest levels are far apart and the level are gonna look too big, something like this. You don't really want that. That is why I said you are gonna have to have judgment in a trading. That is where chart time come into play. So the more you practice and the more you can draw the levels them better and more effectively. But on a whole, you just want to draw something where it's not too big, it's not too small, we interact with all the levels or all the touches. So right away, we can draw this, support that. So we know so once price come within this general area, we can expect either a reversal to the upside or price can break it. So let me now draw a resistance. A resistance is basically the opposite. So this right here, so this is a resistance. See that? Where price touch it, just like a roof and tennis ball, the price interact with this resistance and then came back down. Touch support, go back up again, touch resistance and come back down. So this come like you throw a ball in your roof and it start bounce between support and resistance, roof and floor, right? That's basically the raw foundation of what the market is. Support, resistance, candlesticks, right? Those are the foundation of what you need to know to understand the markets. So right away, even if you're a complete beginner, you should know, be looking at this and have a general idea of what you're looking at. Looking at the green candlesticks, and know say, oh, these are bullish candlesticks. They look on the red one, them and know say those are bearish candlesticks. Then you have to see the wick them upon them. Then you have to can identify say, oh, once price make a reversal. This where I'm kind of lost. Mel Tomlins, unmute a microphone and explain to me why you're lost.
It's just the part where you see the support and resistance, like the floor and the roof. I kind of get that part, but I'm actually not sure which part on the graph. Me, I go find that. That's a kind of my problem.
Okay, all right, all right. So, all right, if you realize whenever price is changing direction, it makes like a V shape. You see that?
Yeah, I'm seeing it.
Yeah, so if you trace the candlesticks, you get a V shape. All right. Up here, so you realize you have a pointed rectangle shape. Make sense?
Yeah.
So all of those points are potential levels of support and resistance. All of those points. For instance, let me draw a random line on this V, on this pointed V. And I am certain somewhere in the future it became a resistance or a support. Let me draw it and show you. Horizontal ray. All right, bam. So this is a resistance, right? Because price touch it and make a reversal and go back down. So anywhere which part price make a reversal or change direction is either a support or a resistance or a roof or a floor. Make sense?
Yeah.
Okay. So let me go in the future. See that? Perfect. You see it? What happened again? Price came back to the same resistance and go back down. You follow?
Yeah.
So anywhere which part price change direction is either a level of support or a resistance. Let me do one for a support now and show you. Look here. This is a support, right? You see where it formed like a V, where price came down, touch it, and then go back up. You see that?
Yeah, I'm seeing it.
Okay. If you look over here in the future now, what price do again? Price touch it and go back up. You see that?
Yes.
So that is basically how you come by support and resistance. Anywhere which part price change direction is either a support or a resistance. Anyway. So basically the market is just a build up of a bunch of support and resistance, and your job is to identify which ones the market will react off to catch your trade. Follow?
Yes, I follow. Yeah. Yeah, I kind of have a better understanding now.
Okay, great. So actually, very good question. And that also leads us into basically going deeper into the levels of support and resistance. If you realize everything is connected, this same level over here, if I drag it across, you realize say it come back, come touch this one over here. So again, they come further at the same thing. So support and resistance is everywhere on the charts, literally everywhere, right? So you as a trader, if it's your first class or your first time learning, after this class, the first thing you should do is go on the charts and identify some level of support and resistance and train your eyes to identify them anywhere you see them. All right. So remember, anywhere which part price change direction is a support or a resistance. Cool. So we have a dive deeper now. The numbers you guys are seeing on the charts, as I realized, remember earlier we said that the chart is basically a graph mapping price against time, right? So right away, you know, say a price we are deal with. But then we dip on the charts, we see candlestick them and move up and down, and we see the price on the right. There must be some measurement. There must be some unit of measurement, right? And that is where a pip comes into play, right? I mean, know say even for some persons who are trade long time, I first time I hear the word pip, because most of it we learn how to trade hands-on, and we never really get the textbook or technical approach to it. But it is good to understand, because here's why I think it is very good to understand what a pip is. It helps you in calculating your lot size. And a lot of persons have issues calculating their lot size. And if you don't know how to work out a lot size, you go keep on blow your account, because your lot size is one of the things that determines how much money you win or lose when you're trading. So I am going to explain pip for you guys in the best way possible. All right? Think about, in a real life, you have inches, you have meter, and you have foot. On the chart, you have pip. So think of one pip as being 1 inch on the chart. So if I draw a candlestick like this from here to, let's say, here, it is a certain number of pips. So if me use there's a tool on the chart, price range. It might not be useful to you guys, but I use it just for this example sake. It can measure how big this candlestick is. So me click on drag, and it say minus 50.3, right? That means this candlestick is 53 pips big, right? Or you can say 50 inches. So if you want to replace pip with inches, fine, by all means. Because in trading, I don't want examine and study for. So you don't need to memorize the terms them like you have one test. You just need to understand what things do, how them work, why it work, and that's all. You just need to understand them. If you guys realize there is a lot of stuff where we're not going to teach, I'm going to need to teach, because you don't need them to be profitable off the charts. I'm only teaching you guys exactly what you need, right? If I'm basically teaching you guys what I would have wanted to learn when I was just starting out. Because when I started out, there was a lot of information, me there all over the place, me I buy tons of courses, and I would never say it's a waste of money. It's never buying a course is never a waste of money, because sometimes you can learn that one missing piece of the puzzle from somebody else, when you would have spent months or even years to learn. So I will always invest in knowledge, right? And after all those years, I realized that the simplest stuff is what you need. But here what? Other persons skip past the simple stuff and want to do the complicated stuff we don't need. So this is 50 pips or 50 inches. So it means that this candlestick measures 50 units on the charts, right? So ensure so you guys know the difference between the size of a candlestick and the price where the candlestick interact. For instance, I send signals to my free signals group every now and again, and I have a private signals group. When I send a signal in that group, I send the stop loss price and the entry price and the take profit price. So in doing your lot size calculation, I realize some persons have issues or they mix up their stop loss price with their stop loss size, right? So this is the foundation we need to understand to not make that mistake, right? So you need to understand, say, okay, the size is different from the price. The size of this candlestick is 50 units, 50 pips. But the price for this candlestick is the opening price is 5,720.6 and the closing price is 5,771. So don't mix them up, right? So now that you guys understand that the market have a measurement you can now look on the candlesticks and now have a better understanding that, okay, all this is doing is representing price movement. How big? So for instance, this big green candlestick measures how much pips? It measures 23.6 pips. Then the one after goes in the opposite direction and it might measure 4 pips. So it's basically a collection of just of numbers, literally, right? So ensure so you don't mix up your stop loss size and the stop loss price. All right. So I'm gonna answer some more question and then move into the next lesson. Let me see where third game. I go ahead, Mr. Up. Yeah, go ahead, bro. All right, seems you have some technical difficulty. Moving on. DeAndre Hill, go ahead.
Yes, bro. Listen, great enough. A question there, boss. How does one get over boom and bust? That's
What
a
again?
very serious one. How does one get overcome boom and bust?
I mean boom and bust.
Come on, boom. All right. So in a sense that you have a, so let's say you start with a $50 account, right? And you grow your account to like say 150, 200. And you take another trade. And you back down to 60, 80. You take a next trade back down. And you go it back to a next 180 again. But you consistently up 180, 150, 150, and up again. So you're not really losing, not really win.
All right, bro. Very good question. So basically, yeah, trade too much. You're trading too much. So typically, I enter 1 to 2 trades per day. Most days are 1 trade me enter per day. And that doesn't mean me trade every day either. You have days when me not trade for even 2 days back to back because I am not seeing what I want to see. So you see, as I get more seasoned in trading, you realize that less equal more. What that means is, you see, starting out as a beginner, you're gonna want to take more trades, yes, so you can build up your experience, build up your confidence, but do so risking less. So you're taking more trades, but you're risking less. So you have more room, you have more wiggle room to make mistakes. So instead of you reaching to 180 and come back down to 60 and all over the place, you may left from 100 to 120, then back to 115, then 115 to 135, then I come back to 130, then I reach 140, and you take time, and you grow, and you grow, and you grow, and you grow. So you have a lot more breathing room when you're doing that than you risking a lot and you trade a lot. So that's in this cycle of doom. So reduce the number of trades I take. Try 4. So for instance, you know what changed my trading game? I analyzed all my winning trades and analyzed all my losing trades. I know what I did. I have some picture on my phone and I'm winning trade them. I'm gonna look back on them. And if I'm gonna take a trade where it look like where on my phone, I'm not take it. And it was very hard. That is why I'm telling you guys say the chart is the easy part. You see, hard part is the mental aspect. That is why a lot of persons may find it hard to find long-term success as a trader because we might not fully develop it, right? We're still young. So you just need to give yourself time to reach to the level where you want to reach. You understand? So always make certain say all your trades them look the same and have the discipline to stick to it. So in the beginning, when I discover that I'm gonna start to do that, I have all 2-3 days I'm not take no trade. And it was very uncomfortable because I felt counterproductive not taking trades because I had the mindset that if me not enter trades, me not make no money and me not make no progress. It is wrong. Not entering trades is making money. Literally, protecting your capital is making money. Is it trading? It's war. You get me? It's war. A you versus you, and even you versus market, a you versus you. Because you know what gonna happen? You ever want to take that trader, and when you win, you say, yeah, man, we can't win again, man. Take one more trade again, and you lose. After you lose, I say, yo, you know what? You can make it back, and you enter again. That is what most traders do and end up in a doom. So, guys, in layman terms, is it trading? Is basically a tool where you see if you're somebody who have the right knowledge and the right guidance and the right approach, you will make money. But if you don't have the approach there and you're just reckless, gamble, you gamble. So you have to know which are you. Are you a trader or are you a gambler? Most persons on the internet are gamblers because that sells. But a trader, somebody who take systematic trades over again. All I trade them are the same thing. So I hope that answer your question, bro.
Yeah, bro, and just add to that, because sometimes you might have a plan, say 2 to 3 trades per day, and if you win the first one or two one, then you come out. Because I have that plan, but sometimes that not sticking to that. Because you might in a euphoria, so you win the one, and you win two, so you're up on a roll. So sticking to your plan is very important, man.
Yeah,
Respect.
bro. All right, the man. So one more question. Kelly, so go ahead. See how now. Kelly, see Anu. Go ahead.
Hello, you hearing me?
Yeah, I'm hearing you.
All right, so I was asking about the support and resistance level. So I was asking, like, do you use past data to determine good support and resistance level?
Yes. So, yes. Correct. Yes. We use past data to determine support and resistance levels. We use past data to determine a lot of things because the market is like a cycle. It repeats itself. That is why you see persons talk about patterns. You have double top, double bottom, inverted head and shoulders. You have all of those patterns, right? I will be going over them briefly, but I won't emphasize on them a lot because it is not the way how I trade. Not to say it doesn't work, because as I said earlier, every strategy have the potential to work. I just you need to make it work for you. So my strategy is based heavily on candlestick and wicks, right? So basically, the pattern you have double top, double bottom. Let me draw it out and show you guys what I'm talking about. So, and then basically fall right back into the level of support and resistance. So you may have a level of support down here, so, and price may interact with it like this, go back up, come back down, and then go back up. This form a double bottom, it shape like a W. This form a double bottom. But let's say you have another touch and you go back up, it becomes a triple bottom. So it can have whole heap of different touches. We don't even need to assign it a name. We just know say it interact with support. So whether I want name double bottom, triple bottom, quadruple bottom, it no matter. It's just pretty much the price reacting with a level of support. Then you have the opposite thing, which is the resistance one. Price interact with it like this, come back down, go back up, come back down. That is a level of resistance, right? Same you have a touch again, third touch, go back down, fourth touch, go back down. What they want to call it, doesn't matter. You just need to understand, say, price and react with resistance. And the rule of thumb is the more price interact with a level, it's the more likely for it to break it on the next attempt. What that means is, if you see price interact with one level multiple times, when I time them, there's a high chance it will lick it down. It will break it. right? Because if you are thump on wall and same spot over and over again, you must thump down your wall. So that is basically how support and resistance work. So when the price interact with it more times, it will break it when I time them. You have a high chance it break it, right? So you have the support, you have the resistance. Then you have another pattern, which is the head and shoulders pattern. You will see it on the charts. No one then will see it. It's shaped like this. You have a touch, then it come back down and make a taller one, come back down again and then make a shorter one and then go down. So the reason why I name head and shoulders is because this is the head and these are the two shoulders, just like the human body, the head and the two shoulders. So normally it basically react with a level something like this. You may have a level something like this, right? So price react with resistance and then break above and come back down same time and pull back again before it go down. So it's like a head and shoulders pattern. Then you have the opposite thing now, which is the inverted head and shoulders, right? Inverted head and shoulders. Cool. You basically have the support down here. So basically, if you realize both the head and shoulder and the double top and double bottom, they are different, but then basically are the same thing, which is rejecting a level, pretty much. So price is basically rejecting a resistance in our regular head and shoulder. And price reject resistance in a one double top, which is this one over here. Price is
Yeah.
price is rejecting support in a one double bottom and the same thing in the inverted head and shoulder. So basically realize I just one broad concept everybody trades, which is support and resistance. But everybody reach that same goal differently, right? So I hope this answers your question.
Yes, it answers my question, and it's just like the example you were showing with the support and resistance level, just
Yeah.
like when price break it
Yes.
and then it goes back up because it was rejecting from the support and then it pushed past it and then it went back up.
Precisely. So by now, I would assume all you guys should now understand the basic candlesticks, understand bullish candlestick, bearish candlestick, you understand support, you understand resistance. Those are the raw materials or the raw foundation where you need to understand. So trading come like you build one house. So we basically have all the materials now. So now we are going to put everything together and show you guys how we put all those stuff together to come up with a trade. Right? So remember, you have support, you have resistance, you have bullish candlestick, you have bearish candlestick. And you know that big candlestick represents high volatility, high volume. Small candlesticks represents small volume, small volatility. Right? So let's jump back and talk about the candlestick them some more. We're going to some candlestick patterns. And I'm basically teaching you guys the only candlestick patterns I think you need. There are a lot more out there, but as I said before, you not have one exam where I go study for what you need for pass. In trading, all you need is understanding and understanding how things work. So remember earlier we talked about the big candlestick them and the small one. I will talk about the big one, then basically meaning high volume, high volatility. And the small ones mean low volume, low volatility. It represents indecision, right? 1 second, guys. All right, so yeah, as I was saying, small candlesticks represents indecision and big ones represents high volatility, high movements, right? So let's talk about the types of candlestick, the most important ones we need, right? You have what you call the doji candlesticks. It's a doji candlesticks are small candlesticks, right? You have four type of doji candlesticks. Four types. Let me see if we can draw them. You have the regular doji, which is small body. You have the wicks on it. You have wick, top wick, and then you have lower wick like this. Lower wick like this. You have the hammer. Don't quote me on the name because these things, the names, as I said before, aren't really important. It understanding where them actually mean is the important thing. So some persons, even me, will mix up the hammer and the pin bar, but then basically I tell you the same thing in the opposite, right? So these are all doji candlesticks, right? These candlesticks represents indecision. So basically, what this mean is, it means price not really make much movements over the span of time. Yeah. It open and close. You go high and you go low, and that's it. It don't really make that much movement. There isn't much volatility in the market when you see a candlestick like this form. The same thing with this. The same thing with this, and the same thing with this. So we classify all these candlesticks as doji. So if you go on Google, I search, you might see them give this doji, you might see this name hammer and this name pinmar and this name dragonfly doji. The names aren't important, as I said. You just need to understand what they mean, and what all doji mean is indecision. Right? That's all you need to understand. All doji represents indecision. Cool. So since you guys know understand the doji candlestick and know say small candlestick means small movements, big candlestick mean big movements. We're going to talk about the most important candlestick pattern everybody should know and everybody use, which is the engulfing candlestick. Right? I'm gonna hope some of you guys are taking notes. The engulfing candlestick. So look at this. Think about price pushing down, right? Price in a one downtrend coming down like this. Bam. Price in a one downtrend. Then price interact with a support down here. So it woke up on a support, and the support is very powerful. Right? Say me have one bearish candlestick where push into the level like this. Put it in a green. Bearish candlestick. Right? Yeah, this bearish candlestick where perform on the level. But then, because the level is so strong and so powerful, the market push up back and react and push back against this bearish candlestick and give you a bullish candlestick. So what happened is the bullish candlestick, basically, 1 second, guys. 1 second. All right, guys. As I was saying earlier, you have this bearish candlestick that basically that formed and interact with the level. Then you have this bullish candlestick perform right after and basically engulf the previous bearish candlestick. Engulf means something bigger, right? It's so light up. So this green candlestick basically engulf this bearish candlestick. That come like a crocodile mouth upon the support, and as the bearish candlestick go down there, you engulf and go some eat up it and push price up. This is a bullish engulfing. Bullish engulfing. Right? That's a bullish engulfing. So basically, this represents bullish strength. So when the price want to go up, you normally have something like this for farm, where price pull back into a level and then you have a bullish engulfing. The bullish engulfing is when a bullish candlestick eat up a previous bearish candlestick. And if the visuals aren't clear enough, they're going to attach a number to them. Let's say this bearish candlestick is 5 pips long. They're going to put -5 because it's going down. -5. Cool. This bearish candlestick is -5. It go down 5 points. -5. Then this bullish candlestick is plus 10. This bullish candlestick is what? Plus 10. So it means the bullish candlestick is bigger and it eat up the previous bearish candlestick. And it now it give you an indication that price have a high chance of pushing to the upside. So I would now assume some of you guys may have some questions surrounding this. So may I go answer a few questions now relating to this, and then we are going to move on again. All right, Rajay, go ahead, bro. Unmute the microphone, Rajay. Yes, I'm going to show an actual representation on the charts. I just want to make sure you guys understand the basics first. All right, it seems Rajay have some issues. Moving on. Alvin, go ahead, bro.
You hear me?
Yeah, I'm hearing you.
All right, so I never realized that the mic did still on. My question, it was like from before. It not really have nothing to do with like the candles. My one is
Okay.
just more psychological, psychology based. So because what my problem is, this morning, me did depend on the V25. Me did get a trade, and me was like $1, but me open like more than one. Me did open like two position, and me carry it to like $20. Me did in profit with $20, but like my mind I tell me, say, yo, if I jump up, bear in mind that then nowhere near me take profit. But because like me I see the $20, me I say, yo, no man, I will heap of money this, and me close it. And right now, like it passed me TP. So if me did still in it, me could I get like a 40 or $50. So I just that a be me always I jump out too early and I watch the market. So I just that.
So you see every issue where you can possibly face or buck up, I've been there before. So you know how me counter that? You cannot tell yourself, say, when you reach to one monetary amount, me I go jump out. You have to have a system surrounding your entry, exit, everything. Because if you rely upon your feelings or your judgment all the time, you'll go bankrupt. What I mean is, I normally have a set risk to reward ratio, which is 1 to 2. So it means that if I'm risking $10, I try to gain $20. And this is very hard to do as well, is accepting your ratio. What I mean by that is, you gotta have time when time the market hit your 1 to 2 and I go way past it. Yes, you can squeeze and try to squeeze some more, but majority of the time, you should just work with your ratio, because we have times, when the market will give you the 1 to 2, I say, yeah, man, I want some more money, I, close out, and the market just turn back and take back everything from you. I have to be like, no, man, that is very painful. You see me? But if you did lose the trade, then you see profits and the market take back everything. So I normally just say, yo, I be disciplined and work with the 1 to 2. As I said earlier, you see, in trading, it's a marathon and not a sprint. So you have to do anything we have to do, or something we have to do repeatable. You can't just do it today and not do it tomorrow. Else you have inconsistent results. As a trader, if you want consistent results, you have to do everything consistent. Right? So I hope this kind of shed some light for your question, bro.
All right, fine.
Yeah, man. All right. So Shadeen, go ahead. See your hand up. Shadeen Stoddart. Unmute the microphone and go ahead with the question. All right. No problem. Okay. Nasha and Barnaby, go ahead.
What if the bullish candlestick it close under it? Why do I expect?
If you close underneath it, I don't want engulfing. Right? But and that is where the time frames come into play now, bro. If you close underneath it, I don't want engulfing. But here is the tricky part. Remember, every time frame it's showing the same overall structure, but the nitty-gritty is different. Because remember, 1 hour candlestick equal to 60 1 minute candlesticks, right? One hour candlestick would equal to 12 5 minute candlesticks. One hour candlestick would equal to 6 10 minute candlesticks. So every time frame might show you a different image and how it
After
reacts on the
speculative
zone.
there.
Yes. So each time frame might show you a different way how the market will react with the zone, but it's overall giving the same information. So, so for instance, on the 5 minute time frame, you may see the perfect engulfing like this. But then on a 10 minute time frame are something different, and I'll get into that. So the main thing is just for you guys to understand the engulfing. So once you understand the engulfing, you're good, and we can move on to the next thing. All right.
Yeah.
All right. So this is the bullish engulfing. The bearish engulfing is basically the opposite of everything down here. So, right? Opposite. You have a resistance, price push up in a resistance like this. Right? Price push up in a resistance, push up with a bullish candlestick like that. The candlestick there might be +5 because it's going up, +5. But then the resistance is so strong where price instantly push it back down and close bigger, right? So that's an engulfing. So this might be -10, -10. And this is the bearish engulfing. Bearish engulfing. Cool. That is it. So you guys should know of a pretty good idea of where I'm going because you know understand support and resistance, you understand say you have the engulfing and the candlesticks, so you know have a pretty good idea of where I am going with this. So let's identify a few of these on the charts. Right away, you guys should know have a better perspective as to everything we are going now on the chart. Looking at this, I realize, for instance, for this was a minor resistance. And if you look closely, you will be able to identify a bearish engulfing right there. And what happened? Price pull back a small amount before going back up. This up here so is also a minor resistance. What is present? A bearish engulfing. Then price push down, right? And then basically down here is again another minor resistance. And what happened? What is present? Bearish engulfing. The price do? Price push down. So you guys know understand say everything work together. The level and the engulfing work together. You see me? So going down, you realize say you have whole bearish engulfing in a one downtrend. So this is a downtrend because the price is going in a one downward manner. Whilst if it's going in a one upward manner, that's a uptrend. So earlier I mentioned the price move like one stairs where price push up, it might pull back, push up, pull back, push up, pull back, then push up. And this has to happen. Let me explain to you the core reason as to why this has to happen. In order for something to go up, it must come down. When you have a slingshot, you have to draw it back, you have to pull it back in the opposite direction to gain strength to propel forward. So remember, when you're buying something, don't say you want the best possible price. If you buy one car for 2 million, you would love if you can buy the car below 2 million. So maybe if you have a sell it, you sell it at a higher price so you can make a money. Right? So the price I got always come back before it go up, same as the price level always go up before it go down, right? Go down, pull back, push down, pull back, push down, pull back, push down. The aim is to always get a discounted or a better price for your trade. That is basically how the market works. So persons buy here, you buy low, the price go up. You buy low, the price go up. You buy low, the price go up. You sell high, the price go down. You sell high, the price go down. You sell high, the price go down. So these are all support and resistance levels. And at these levels, the one thing that you will see that will confirm those levels is the engulfing, literally engulfing. So at this support over here, you're expecting a bullish engulfing, then this one a bullish engulfing, same thing here. For this one, you want to see bearish engulfing, bearish engulfing, bearish engulfing, right? So there is a name for all these points. So the lower point right down here, so where price pull back before pushing up, is known as a higher low point, because all of these points are high points, but they're higher than the previous low points. So these are all low points, but it's higher than the previous low point. So this right now is a higher low, higher low, higher low. Let me write it down. Higher low. Right? So HL. HL mean higher low. Pretty much higher low. See? And then for the downtrend, you have lower high points, because all of those points are high points, but it is lower than the previous high points. And that is where the trend line come into play. So even though we don't really trade trend line can be drawn from these points going up, and persons use this as an indication for them taking a trade, depending on what they're looking at. So for a bullish or for a buy, you have the bullish trend line like this, where price is going up, and then the idea is when price come back and touch trend line, you take a buy. For the sell, the opposite thing. The Kaneki low point them, price go down, when price come back to it, you take a sell. Right? That is basically market structure. So you guys should understand how everything come together. The support and resistance, the engulfing, everything comes together. So I would now take you guys that have some question. So what I'm gonna do is give you guys a 5-minute, a 10-minute recess to clear your head and just kind of meds everything and resume at 3:15. So see you guys at 3:15, all right? So make sure so we not take notes and just relax on the brain and make everything soak in. See you guys at 3:15. All right, guys. Welcome back. Welcome back. Welcome back. Welcome back. All right. So we've been through pretty much all the basic stuff I think all of you guys should need or should understand. All right. So we're now going to basically put everything together and break down how we catch a trade or how we identify potential trading opportunities. Right? So basically, we know that we have the candlesticks, we have support and resistance, right? We have those stuff. So we just need to know how to make all of those stuff work in our favor. Cool? The first thing you normally do when you approach any markets or any charts is you want to identify the trend of that market, right? You want to identify the current market trend. Cool? And identifying the trend should be easy, and it is easy. Whenever identifying the market trend is tricky or is unclear, is when you should not trade. That right there is the first pro tip you guys should know. Whenever the market trend is not clear, you do not want to be trading, right? If you have to look too deep or too far to see if it's going up or down, do not trade. Cool? So, looking at VIX 25, VIX 15, is right away we realize that this is a downtrend. Why? Because we have consistent lower high points coming down, right? We have a lower high point here, right? We have another lower high point down here. Cool. We have lower high point here. We have lower high point here. So we know that this market is pushing down. This is a lower high point as well. So it's clear that this market is pushing down. So you never want to enter buy in a downward trend, and you never want to enter one sells in an upward trend. So the only thing you will be taking from here is a sell opportunity. That's all. Right? That is all you're taking from here, a sell opportunity. Cool. So we are now going to look at this market and identify where we can take potential trend sells from using logics. Right? Using logics. So remember earlier we draw something like this. We draw the market pushing down, creating lower high points, pushing down, right? And you realize that it can be broken up into parts where, let's say this previous part is point A and it push down to form point B down here. So then point C is where the price pull back to the level or the resistance before going down. Let me draw all of this better so you guys can have a better understanding of what I'm talking about. Remember to keep your microphones muted. Price pushing down, then price pull back like this, then price pull down again, then price do a pullback. So ignore this over here. Let me delete it, by the way. Ignore that and look at just this part. Let's say we label this as point A, and we label this down here as point B. Cool? So when the market make a move, it move from point A to point B. So A, B, right? That is the first leg of the push, A and B. If you're not seeing my screen, it means you're on the wrong section of your phone. You need to swipe cross or something. I'm not sure what type of device you're using. If you guys are seeing my screen properly, type 7 in the chat. Okay. Okay, great. As I was saying, the push can be broken up into phases. You have point A, then you have point B. That's the push phase. Then you have the pullback phase. The pullback phase now is normally from point B to point C, right? So point C would be the pullback phase. And this is where the sauce of the formula comes into play. You as a trader will be looking to take your trade from point C. So basically, you want A, B, C, then D. So point D at one time, the market would go in your direction and your TP smash. You just call that D. So basically, you achieve A, B, C, D. Cool? This you actually achieve. A, B, C, D. Your job is to identify where the point C are go there. You're not gonna always right and sometimes you go wrong. But once you get it right, you're good. So when the market pull back, it can pull back either here so, here so, here so, or it can even go a tad bit above. Or you can change direction and just continue to go up and don't come back down. You can't predict the market. But based off of historic data, we know that whenever you have a downtrend going down, price would normally pull back and then go down. But here's where now the formula comes into play. Most persons would be thinking to take their trade when point C basically interact with the previous resistance from over here. So for instance, let's say the market was moving something like this over here, right? And this is a level of support, right? So imagine this being a level of support. Cool? It's a support level. I'm turning this in a black. It's a level of support, right? And remember earlier I said support can become resistance and resistance can become support. So this support become a resistance over here. So most person would be thinking to take their trade where C is exactly at this resistance. While this method works, because remember I said every method has the possibility or the potential to work, and you have to just make it work for you. When price pull back to C or to the previous support, will now become resistance. Most persons would take a trade from here. And earlier I said it can work, and it works because I can find examples where the market pull back perfectly to the previous support and become resistance and the market drop, right? I can find scenarios where this work, right? But I wanted something that have a better edge for me. It might equate to me getting less trades, but it gives me a better edge. And I am comfortable with giving up a few more trades to have a win rate. Keep your microphone muted, guys. So I rather to have a strategy that gives me less trades but have a higher win rate. So what my biggest rule is to enter the market when point C is as close to point A as possible. So it means I am not going to enter my trade when it pull back to this first resistance. Most times, almost all the times, you have to find a minor level of resistance near to point A where price can potentially pull back to before going down. So when the price push up almost back to the same level as point A, that is when I look for my entries. And I'm going to explain exactly why. When you're trading, it is crucial to use a stop loss. Your stop loss prevents you from losing more than what you set out to lose. So in this scenario, we would take a sell trade. So on trading view, we would go over to where the tools are and you look for the fifth icon coming down, click on it, and you see long position, short position tool. You will just star and add them to the favorite, and then you will see them on your quick bar on the screen like this, where you can select them with ease. So I'm going to use a short tool to demonstrate to you guys what a sell trade would be like. When you click it, you get something like this. You have one part red and one part green. So remember, short equals sell. So this is demonstrating a sell trade right now. right? Where you're entering the market at 13,584. Your stop loss, which is the red part, is at 13,600, and the take profit, which is the green part, is at 13,569, right? So this represents a markup trade where you enter here, your stop loss is here, your TP is here. This is okay. But to put odds in your favor more and to ensure, say, even if you lose more trying to still make money, you need to have a positive risk to reward ratio of above 1 to 2. So you won't be risking, because in this case, the stop loss size is 15.4 pips. Remember, we talked about pips earlier, which is the inches on the chart. So the size of this stop loss is 15.4, and the five of this take profit is the same 15.4. So you're risking one thing to gain one thing. You can't be profitable long term doing that. You have to have at least a 1 to 2. So you will keep your stop loss the same, but target more. So you get the 1 to 2. So you're now targeting 32 pips as opposed to 14. So basically, when you're winning, you gain 2 times what your risk. And that is what makes trading make sense. The risk to reward ratio. Right? So the reason as to why I would want to enter when the market is as close to point C as possible is this. Let me turn this off so we can enjoy it better. Hide. All right. And clear these. Come on, you guys really understand this, I don't want this flavor on it. I want to know if you really understand this. Look at this now. If you should enter the market down here for price push down, you would basically enter here, and in order to have your stop loss in a safe place, your stop loss have to end up like that. That is big. That is too big, because you would have to target a massive target like this. If this makes sense. And always remember this. The more pips you're targeting, the longer you can potentially be in the market. I repeat, the more, just like if you drive, the longer the journey and the more time it takes. The more pips you would target, the longer it potentially takes for your TP smash or your stop loss hit. When you're targeting, let's say, a smaller amount, it hit faster. That is where you may hear the term scalper, day trader, and swing trader come in. A scalper is somebody who targets smaller price movements in a one quick time. Maybe them trades he take profit or them lose in maybe like a span of 5 to 6 or even 8 hours, but it's within the day. It's not the whole day, but within the day. A day trader is a little bit above the swing, the scalper. Them spend a little bit more time in a one trade. Them trade may even roll over into the next day, right? And then you have the swing trader now. Swing trader is somebody who hold trades for days, 6 days, 7 days, even a week. The other person who hold even longer. So I am a scalper by nature. My trade smash TP, I'm losing maybe like a couple of hours maximum. Sometimes we take trades and within 30 minutes, me either lose or me win. Because that is how I like it. I trade because I want freedom. So the less time I can spend on the charts and in the trade, the better it is for me, while still being effective. So the reason as to why I enter when the market pulls back a lot deeper is because I want to have a better risk to reward ratio, and I want to increase my odds of winning. So what I do, I play the patient game. I wait. So instead of doing this, where me have a big trade like this, I wait. So I enter when the market pull back deeper, close to point A, where we can enter something like this. So me end up with a smaller stop loss where my 1 to 2 get hit a lot sooner. And this is why I have such a high win rate, because when I'm trading, I am executing using this principle all the time, right? Literally. So with this allow me to do it, yeah, I get smashed as price start move up. So it's either I'm lose or I'm win. But most times mute a microphone, guys. Mute a microphone. Yeah. So as I was saying earlier, when I trade like this, it gives me the best win rate, in my opinion. Right? And this works for me. And I've been doing this for the past couple of years and it's been working. So you don't need today to do all over the place for trade. You just need to understand one thing, stick to it and master it. Right? So even if let's say this style don't work so with you, you just need to learn what works for you and just focus on that. But just don't try to be everywhere and all over the place. Right? Don't make because you lose today or you lose this week, you give up or you change strategy completely. No, don't do that. You will forever stay in the same cycle. Right? So I'm now going to answer some questions as it relates to this before moving on. So raise your hand if you have a question. All right. All right. Matt Bean, go ahead. You see your hand up.
Your formula up the hand from a good while still. I think they were the engulfing part still. I say enough time look for the engulfing. I'm gonna take it for the engulfing, but more time the market push. Like it go the opposite direction first. Then it go in the right direction when I want it go. Even though I take it off for one engulfing. That reach me most of the time then.
Okay. All right. So that can happen, but a certain way you can't stop it, you can't prevent it, and you can't predict it. What you can do is make sure you say a stop loss. Everything come back down to your stop loss again. Ensure you say a stop loss there in a proper place where you give the market room to breathe. Where if you want to come back and play around, you can come back and play around. Understand?
Yeah man, that for true man. Stop loss ever tight, you know. You know I lose a little bit of money.
That I think so. Reduce the lot size, reduce your risk, and use a little bit bigger stop loss because there's no sense in trying to run down tight stop loss and you lose. But you have a bigger stop loss and you win. Make sense?
Respect.
Yeah, bro. All right, Rajay, go ahead, bro. See you now.
Oh yeah, my main problem is psychology.
Yeah.
Like when we place a trade, so my time I want to say if market I go just reverse for me or and for just let you make it run. That's mostly my problem. So my time like when I lost,
Yeah.
and then we just decide to close it out and then it just go straight to TP.
You know
Don't know
exactly.
what kind of psychology.
All right. So basically, how me prevent that is, you see how me explain the formula, the ideology with confidence. You have to believe in a way I do. If you have confidence, you believe, say, yo, all if you win or all if you lose, you still believe in it. So when me enter one trade, bro, I just tell myself, so win or I lose, it no matter me because one trade does not dictate my result. Right? So me not put too much weight, me not put too much emphasis on one trade in terms of it affecting my psychology. So whenever me see a trade, I me enter one trade, I trust in the formula. I trust in the formula say, hey, is it I'm gonna win or I'm gonna lose? For instance, this week I had multiple trades go halfway in profit, turn back and stop me out. Some of them stop me out and then go to take profit. Now, if you just accept that is normal, but cannot prevent that. You can't prevent that, bro. And I do not make a bad week corrupt a good potential week or make it show me off. For instance, after let's say a bad week, some persons might feel them confidence about naturally lower, but then you have to still trust in a way you do. Because the hardest part after one losing streak is still remaining the same trader you were even when time you win. Make sense, bro?
Yeah, no.
All right. Nikisha Mitchell, go ahead.
All right, my question is right between your
Yes.
support level on the thing that you draw to point A. how effective you think is the Fibonacci retracement pertaining to that?
Very good question. So remember earlier I said everything basically rely upon the same concepts, support and resistance and the pullback. The Fibonacci retracement basically demonstrates a similar thing, but in a one different way. So basically, you would draw your fibs from point A to point B. But the fibs basically measure the pullback as it relates to the first swing. What I mean by that is when you draw the fibs from point A down to point B, it measures the pullback. Let me fix it for a bit because it might look confusing to you guys. Let me fix it and take off. I need to take off. All right. Bam, bam, bam. This can take off that, take off that. That can stay. That can stay. That can stay. That can stay. That stay. Take off these two. All right. Look at this now. Basically, so from point A to point B is, let's say, is 1 to 0. But the pullback from A to B is like a measurement. So if the market did pull back to let's say down here, so which is 50%, it'll tell us say the pullback where you going to enter your trade on is 50% of the first push. Right? Make sense?
Oh.
Say pull back halfway. And remember I said earlier, I like when time point C is close to A. So basically I am entering my trade when time the market pull back to above 60% of the first push. Make sense?
Yeah, I cannot get the clarity because I thought you'd do the phlebotomy retracement from the support line to A. I never know it was from B to A.
Yes, I'm gonna draw it from A to B, A, B, and then
Yeah.
C is a pullback. But as I said earlier, the first thing I said on the class is I try to simplify things. So while the Fibonacci retracement is a great tool, it works. I realize that I end up with the same results by simply just knowing that once A and C is in close proximity where my stop loss can go above point A, I am good. Make sense?
Yeah.
I'm spend less time analyzing and me spend less time confusing myself because the more stuff you add and the more stuff you do is it's the easier for you to get confused. Make sense?
Okay, all right.
Yes. All right, Terrence Smith, go ahead. See you up.
Alright, so I just started trading like 2 months now. Within the first month, I would say I blow my account twice. I nearly blew it like three at a time within the first month. After, because when I go through TikTok, you see a bunch of videos where make you feel like you can flip $100 and $1,000 and 2,000. So take some big risk. And then when we try to take the smaller risk, it can take a while, and it affect my patient level because to sit down and watch a trade for 5 hours just to make $5, it can seem like really worth it here in a sense. And then when me risk big now, I realize psychologically it's like me a stare upon the screen. Like as soon as you make a move, like it go opposite to where I want, it's like man jump out. It's like me just get nervous same time I want jump out. And
Trust me,
it really affect me up to this point.
and that is why trading is amongst one of the hardest skill to master. Because when I'm going to sugarcoat it and tell me say easy, because I said earlier, it is difficult. And I'm glad say you admit and you realize say it is more of a mental game than a technical game. Right? Yes, you need to have a a solid formula, you know, but it's a mental game, bro. Because just like what you said, when you're risking small amount, you feel like it don't make no sense. And risking the small amount is the right way. Literally, boy, what? It easier said than done, and it hard to do. Because how much people, remember I said earlier, if you have deposit anywhere between 100 US to 300 US, you must to pay one bill. And remember, if you have a bills account, you make 5 US on the account there in the span of a day, which me know everybody on the class can make $5 per $100. That is 5%. Most investment now give you 5% in a one day. And if you can average 5% per week, 6% per week, consistently for 52 weeks, you have a business where can generate a lot of profits. But it's a numbers game and most persons don't understand the numbers. Whereas statistically, most successful traders have a win rate between 20%, have a profit percentage gain of, let's say, 10% to 20%. So what that means is if they deposit 100 US on average, most persons only can maintain growing it 10 to 20% over long term. The key word is long term. Yes, they can flip the 100 US to 1,000, 2,000, 3,000 in one day. It is possible. But as I said, it is not sustainable. What
And
is
one more thing.
is percentage growth. So per month, I would say try targeting, let's say, 20% for the month. That's like one
Okay, me
per.
not lie. Me watch me see a change must say $20 to 6 bills or something. I say, oh, this man kill it possible. I will not lie. We gonna try the same thing like me. I say, boy, if him sure say possible, I never skip one of your video. Them. But definitely realize I can't rush it.
All right. So let me show you the dark side of flipping accounts, bro. You see, if every successful flip where you see me do, me have maybe like 6 or 7 failed attempts.
Yeah.
And that is the dark side about trading. You see me? So we know you might see we post 20 US to 6 bills on a single trade. Maybe you don't know how much time we lose that if you do that. That is the dark side, bro. You see me? So that is why I tell you to say you have to focus on consistent percentage growth. Because anyone now we can flip an account, but you have to fail a couple times first. You understand? I can withstand those failures because me understand the numbers and me understand say, hey, whenever I'm going to attempt a flip, me condition my mind say me can lose a bills here, me can lose a $50 here, me can lose a 3 bills here. But most persons just starting out at the last 3 bills, at the last 2 bills. You get me? At the last of the money with them have, so them attached to it. So they make different choices. I am not attached to the money. Right? Because first thing, I am not going to trade what I can't afford to lose. And that's a big thing. When you trade where you can't afford to lose, it shows off your complete mindset. That is why I don't believe in trading for other persons, because it put you in our mindset where you're afraid of losing the money. Let me give you a scenario. It's when I had my 9 to 5 and more than say me just discover trading, I just feel like me I make real progress. I just say that me I make results. I feel like say, yeah man, I have it now, man. Me and my boss did have one good relationship. And him reason and them thing there. And him give me 100 US for trade fee. And lucky enough, me end up flip it. Right? Me flip it to like 2 bills and me give him back the money when him give me and me have back the bill left in my account and I say, yeah man, so me give him back him capital. So now I profit him for making now. So at this point he can't go south because worst case scenario break even. And believe me lose all of the money. See, me lose all the money and I say, never again. Never again. It no matter who, me not trade for nobody. Because the mindset there, it no matter who, it have a shake you up. Because When you risk your own money, you at ease. Me know say we can afford to lose, let's say a certain amount, and you maybe can afford to lose a smaller amount. You work with that. Don't try push to where you can't afford too fast, too soon. You will give up. I don't want to give up. More everybody to actively trade because every trade is a building block in your success. You see me? Remember Rome name building in one day. Every house have thousands of block. Every trade is those thousands of block. In the beginning, you might not see the results and feel like no progress now make. But let me show you something, guys. Let me show you how things compound in a life. See? You see when time you trade, you see between just like, same like on the graph, on the charts. We have time down here so and results up here so. You see in the first couple of years, the growth very small. They feel like no progress. Blown accounts, everything no progress. And in a matter of just maybe a day or a week, your whole perspective can change just by getting the right information. And your progress just starts to skyrocket like this. So
Yeah.
don't make because the first half of your journey rugged and rough. Everybody journey rugged and rough. My first half of journey rugged and rough. My blow over 10 100 accounts. 2 bills each. I blow other accounts on different platforms. Like I blow FTM accounts, my Forex funds, I blow whole heap of accounts. I buy almost every course I can think of out there. And at the end of the day, I come back and realize everything simply it's all in the mind. It's all in the mind. Literally, bro. So I hope that shed some light on.
One more thing. Your first expert make I ask the question, I know. When we go on YouTube, usually when them I explain or analyze the chart, them start cover some topic about order block and fair value gap. But them not use it on synthetics. They not use it on VIX or nothing like that. Some I know plenty thing that apply to VIX as well.
Yeah, you want to know that too, formula boss, also.
What again?
Want to know that too, also. We might have
Oh,
a
yeah,
lot of
man. All right.
question.
Very good
All of
question,
that,
bro.
very gap, also.
Very good question, bro. So
And
very, very
supply
good
and
question.
demand. Too.
Very, very good question. Remember, I said earlier, everything come back to the same concept, support and resistance. So all of those are fancy names to the same thing. I am not going to tell you that them don't work because almost every approach have the possibility of working. You see me? Remember they say 6 or 1 half does not the other, right? So all of them fair value gap and you have potential can work. It's only a different approach, right? All of them have uniqueness to them. I don't understand all of them because I know within myself that I do not need. I have never watched a video talking about fair value gap. Me just, me don't even really understand one name so. All that black me understand say it's similar to having a deep pullback back to where price is coming from, right? But me not really focus on that. Me focus on the simple stuff because I know that at this matter, literally the simple stuff. So yes, if that is your strategy and it's working, you stick with it, right? Because as I said before, everything have a potential for work, but the simpler you keep things, the better it is for you. So what I have realized over my years of trading and validating the index is I just try to focus on entering and the deeper pullbacks. And let me explain to you why. Remember I said earlier, you see, trading is war. A you versus you, but it's also you versus the markets. You see me? And you have to think in terms of this. The market is not there for you just come on the market and make money whenever. The world wouldn't be balanced. The world wouldn't be level. There have to be some level of barrier, some level of hardness to it for you to work and achieve and push through in order to get to that level. Right? So the market moves in ways where you think get a manipulate you. But really and truly, it's a manipulation, it real and it not real. Let me explain to you what I mean by that. The market has to quote unquote manipulate. It has to manipulate. Let me explain to you why. For instance, look at this. We're in a downtrend, right? We're in a one downtrend. We have a level of resistance right here, so right? This is a resistance. Persons, and then right down here, so is a sort of resistance as well, because you see your price interact with it, came back down and then go back up. And this is why I'm telling you, say, keeping it simple always works. Let's say somebody enter here for a sell, they would have win. Let's say come back again and somebody enter over here, so and then get stop out. They must say, oh, a market manipulate. In which way the market are do what designed for do. The market will take from traders who aren't patient, who aren't practicing a proper strategy, and now do the right thing, and give to the ones who are doing the right thing. So the market have to manipulate feed to continue for work every day. So if you not exercise properly in terms of having the right strategy, having risk management, you're gonna mess up or you're gonna lose. So for instance, the correct way to approach trading is this. You have to give yourself room to make mistakes. If I entered my trade, let's say somewhere up here, and we get stop out, you can't stop it, you can't prevent it, right? I look for engulfing before I enter my trade. Currently, right now, there isn't the engulfing on the 5-minute time frame. I would check the 10-minute time frame to see if there is an engulfing. Right? There is no engulfing. So me wouldn't enter no trade right here. So that automatically save me from entering a trade and getting stopped out. Right? So me know some persons might look on here and say, all right, the price might go up, come back down, and then manipulate before it come back down. I don't really view it like that. But just view it as the market have to do in order for it continue to flow. So everything have the potential for work. For instance, I remember one time I was focusing on only taking trades based off of the 1 hour engulfing, right? And believe me, it worked. My only issue with that was sometimes it take me long to find trades. Me and wait too long for trade them, and then them just take too long. For instance, if I was taking a sell trade every time I see 1 hour engulfing on this chart, believe you would have gotten good results. Depend on your stop loss placement. For instance, right in here, so you could have spot a sell. Right in here, so you could have a sell, stop loss right there, and then a target a 1 to 2. See that? You'll win this trade. But then if you take a trade down here, so you would lose this trade. So everything is a distribution. You have to be smart and know, so yo, no matter what you do or what you trade, you can't win everything. So the difference with trading a simple strategy and using something complicated might just be 1% difference or 2% difference in win rate, which, if you ask me, is not worth the effort. Make sense, bro? Make sense?
Makes a lot of sense, man.
Yeah, man, makes sense. Man. All right, bro.
Yeah, it makes sense, man.
All right, so Taji Johnson, see you on up. Go ahead.
Yeah, I say it makes sense, man. While ago that show, while ago the first sell rate up there, so it take profit lick. But afterwards, if you don't make a sell, they say it get stopped out. Too late. You're late for that trade here, actually.
Okay, so when you realize, say, in no matter where you trade or what you do, yeah, I got have classes.
Yes.
Exactly. So the main thing is to just know, say, yo, manage your risk and make sure, so when you win, you walk with at least 2 times where you are risk to keep you on that positive side. That's all you need to do. All right, Nasha and Barnaby, go ahead. See you on up.
The first chart with A and B.
Yes.
No work point there.
Let me see if we can find it, because my chart did refresh a while ago and I never get to save it. So but potentially I have to go draw it back. So you can tell me what exactly about it you don't understand?
No, I'm just say like if point A,
Yeah.
like you go point A and you go back to point E. Why if it disrespect point C and back it show you back a bearish engulfing candle? What you gonna do in a situation then?
Hold on, let me draw it back so we can fully understand where you come from. All right, point A, point C, then point B. Okay. All right. So go on again with the question, bro.
So you do all of that, but it disrespect point C, but it show you a bearish engulfing candle after it disrespect C.
Oh, so we are saying come back to point C and get engulfing.
Yeah, but it disrespect point C first.
Or you go higher.
Mm-hmm. But it
Okay.
show you the bearish engulfing.
All right. Very good question, bro. So now I go answer the question there by showing you guys how market interact with levels. The market interact with levels in basically 3 different ways. Cool. And you see, understanding this saved me whole heap of time. And it took me a long while to understand this. When I just started out, I thought that the market is perfect. It will react with the levels and perfect like this, and then do that. React with the perfect touch, and then move off. I thought the market was this. The market is not that. The market not perfect. You can't predict the market. The market can either give you a perfect touch like this, or it can come and gap the level like that. It respect it, but it gap it. Think of it like a like a field, like a force field. It come within the general area, but it just not touch it, but it still respect it.
We said things said way.
And then the market can overlap the level. This is why I mean, I really think in terms of manipulation. The market is just doing what it is supposed to be doing. See? So you see, once you understand how the market react with levels like this, you are going to know, condition your mind for worst case scenario. That is why I say, don't try to use no tight stop loss. Use one stop loss when they're above point A at all times. So if price should do something like this, if price should do something,
Yes, father.
wait, I remember, point A,
I understand now.
point A is a resistance. Remember, point A is a resistance. So if point C should go above point A, once it not go above it too far away, it basically make it invalid. Once it go above it like a small amount and come back below it, invalid. It just means the market interact with point A and give you a overlap type of reaction to the level. So you see, once you understand that, you know how to approach the market with a feel safe in your mind. Say, okay, all if we see engulfing, doing so, I'm going to enter my trade, doing so. I'm going to put my stop loss above point A, one decent amount. Say, if you pull back within the area there, me still good, and me 1 to 2 TP can potentially smash. Make sense?
Yeah, father. I get everything, get it.
Makes sense for me, but
I have one question that
All right, go ahead with the question. Go ahead.
yeah, man, Camarilla is saying never see and but in case you blow an account, what you just say is the average or general start over amount.
Bro, that depends heavily on what you can afford. Because here what to, and because it's tricky, very tricky. You see, where you can't afford to lose, you can't trade the amount of money there effectively. For instance, if you can't afford to lose 100,000 on the market, somebody can give you $1 million right now and you blow it. Because you don't reach to that level there yet. You don't reach the level there yet. It's not straightforward as most I would think. It's a mental thing, as I said again. You see me? So if you know, say, you can afford to lose 200 US and Yes, I go feel away, but it no hurt your way. When time you're actively trading, you know, attached to your trade them, you're good. So if you blow an account, and most beginners will blow their first two account. I guarantee that. If you're a beginner, just know say you're gonna blow an account. Nobody gets away. There's no trade on this earth will learn how to trade properly and not blow account. So if you think say you're coming to trading and not blow accounts, you have a sad mistake because you can learn this thing exactly as I'm teaching it. But you see, by the time you start enter your first two trade them, you're gonna say, wanna make money. Boom, big lot size. You might make a money. And you say, yeah, man, the confidence very, very high. You feel like you're up on top of your world because I know. And then everything hit. You lose on trade when you risk too much and half of your account gone. And then you have to try for revenge and lose back everything. You see me? So
I
it
know
all
that all the time for me.
lose. So if you can afford to lose 200 US or so, you work with that and you just minimize your risk. Your risk like $120, $115 per trade. You take a time and grow. That's all I need for the bro. I try to use your account, be a 1 or 2 bill if needs be, and you take time when you scale up from this. So that is how you will build consistency to eventually be a full-time trader.
Another question to Chief. It's in relation to lot size. All right. So as I said, me normally when I do develop a trade, me normally you say risk small. Then so me normally do a 0.1 or so forth. But as it relates to lot size calculation, it mentally truth, me never really capitalize on that yet. So
Get
still
into
don't
that.
know if it do proper lot size calculation. I mean, I don't know if I can show.
Yeah, man. So that may I get into right now because we're heading to the closing segment of the class, which is how you put
Well,
everything
me
together,
formula
how
boss.
to enter your
With
trade.
$100, what's the best last size? You start with $100.
So listen to me now, bro. There's no best lot size for no account because every single pair, every single index have a different lot size. So me can't tell you say one lot. If you use one lot per VIX 75, you have thousands. Or one lot per VIX 50, not possible. So every index have a different lot size. You have to calculate your lot size. So I'm going to show you now how to work out a lot size. I'm going to show you a step-by-step guide on how to enter your trades. So let me clear all of this. You boot up a chart, you're going to do an analysis. You're going to look for one trade. Or you're going to take one little demo trade or so. See? So you're going to look for one 5-minute engulfing. Whether it is bearish or bullish. So look for one 5-minute engulfing that matches with the trend. Hopefully we can find one at this time. Hopefully we can spot one. Let me see. So at this point, all you guys should now understand the basics about trading. You should now have a pretty good idea as to what everything is, right? You shouldn't be a dummy towards the chart no more, right? So I'm showing you guys now. All right, look at this. This is the same VIX 15 one is. Yeah, man, but didn't know said they were provide on trade, you know. VIX 15 one is 5-minute time frame. All right, look at this now, guys. Let me go up on a clearer time frame so I can see it even better. You guys seeing this?
Yeah, man.
The market start from here, push down, then it pull back, then it push down, and then it pull back again like this, and it give us an engulfing. So that right there is a valid sell entry on VIX 15 one is, right? This is a valid sell entry. That is a point A. The only issue with this right now is it's too far from point A. That is the issue. But then, you see, with trading, You have whole heap of different approaches where you can take. What I mean is, yes, the point A on the 15-minute time frame is all the way up here. The higher the time frame, the more reliable the levels are, right? That is point A on the 15-minute time frame. But if I go down on the 5-minute time frame, some persons might say this is a potential point A as well because it's also a pullback. So you could draw something like this. And this is why you have to practice the utmost risk management, because no matter how perfect the formula is, you have to always have some trades where you have to take them. You might know the perfect way you have to take them. Because this trade right now is a valid trade for me, because this would be a point A that I would work with. So remember, point A is where the push start from. If you realize one push start from here, so and then it come all the way down here. B. See? So remember I said earlier, you want to enter when point C close to point A. This was a point C, but this point C never follow through and it never come back close to this point A. So price push down and actually come back nearer to point A. And if you look closely, price also respect this level of resistance in here. I know all of this might be a little bit confusing. Now go over it again. Point A, where the push start from, point B, and then this would be considered maybe like a false point C, right? So you would take an entry from here, then price pull back down, and then this now would be an entry that you could potentially take based on the fact that if you enter a trade here and if you zoom in closely, we'll have an engulfing pattern present. This right here, so that's a bearish engulfing. That indicates bearish price movement. So if you should know, enter this trade right here, entry at current price, your stop loss can easily be above point A at 19.1 pips, right? And then take a 1 to 2 like this. That's pretty much it. So after doing this markup, you would know basically input this information in your MT5 app for this trade. See? So the lot size, after doing all this markup, you're gonna need to calculate a lot size to enter your trade, right? So basically, lot size is equal to, I'm gonna type it out and show you guys. And please write this down or pay attention. Lot size is equal to risk amount divided by stop loss size. Remember we talked about stop loss size earlier and how it differentiates from stop loss price. Remember that. So you basically divide two numbers to get a lot size. That's all you're doing, dividing two numbers. The first number is your risk amount. How much are you risking on this specific trade? If you're risking 20 US, all you're doing 20 US divided by the stop loss size. The stop loss size for this specific trade is 19.1. If you click on the tool, you would see it's a stop colon 19.1, 20 divided by 19.1. Divided by 19.1, and the answer would basically be 1. So your lot size for this trade would be 1. When you're going to enter your trade, instead of wasting time trying to enter the lot size and then put in the stop loss size and then take profit price, you're only going to input your lot size, then press sell or buy. Then you will now go back and modify the trade, put in a stop loss after. Because based on how I trade, my entries are very fast. If you're not careful, the entry occur and gone left you. Like oh, right now the market kind of gone in a profits. If you go down right now, the entry gone. So you just put in a stop loss, enter the market right away, then put in the stop loss after. right? So we hope that was clear enough for all of you guys. So the lot size is just you dividing your risk amount by the stop loss size. Make sense?
Yeah, formula boss. It makes sense.
Yeah, man, makes sense. And we in a
So
profit,
this
man.
trade right now,
Yeah,
this
father.
trade right now, one again?
No, me I agree. Me I say it makes sense.
All right, guys. So this trade right now on the screen is a valid trade opportunity. I am going to enter this trade in my signals group and also in my live account.
A 5 minute time frame then.
Yes.
Uh,
It is also a plus for you guys on the class. Gonna get a live trade. $6.15 one is. All right, so actually I go wait and see if price like actually come back nearer to entry before me enter, because if me enter down here, so me not like the risk to reward and my stop loss have to go bigger. So me have to wait until this kind of come back. If it doesn't come back, then so be it. We miss a trade. If it comes back, then we potentially catch a trade. So let's see. All right. So in the meantime, I'm going to get to some questions. All right. Kempton, Brian, go ahead. See your hand up.
Alright, bro. Greetings.
Greetings.
When I do a markup, which
Yeah.
one I high time frame I do a markup on? Can me say you would have take your entries for the 5 minute. Which one I higher time frame most ideal for the markup spot?
You can use like the 1 hour time frame.
Alright, cool.
All right. Next person, Elisa, go ahead. See your hand up.
Hello, you hear me?
Yes, I'm hearing you.
My question was from the engulfing.
Yes.
I was asking like which time frame is it better to enter the engulfing on? Like for wait on the engulfing to farm on 4 hour, the 1 hour time
Okay.
frame,
Very
or
good
15
question.
minutes.
Very good question. So the engulfing is basically an entry criteria, and the entry time frame is normally like the 5 minute, 15 minute, or the 10 minute time frame. So if you see the engulfing on the 10 minute, 5 or 15 minute time frame, then it's a valid trade opportunity.
Okay, thank you.
Yes. All right. Philip Pino, go ahead. See you know.
Yes, man. Um, Great presentation so far, Formula Boss. Just enough respect for your time and giving us all of these gems, because yeah, teach me a whole heap of something. My question now is the which my brethren just asked a question like this: which time frame you recommend to mark up the zones? Because you recommend 1 hour to him a while ago, but we're up on the 5 minute right now, and you just line off some zones with the horizontal rays. And me I wonder, like, if me was to do that, normally when me try and do that, me end up with a whole heap of lines from my chart. And me here say you recommend so we must keep things simple. So you know where exactly is a zone, because sometimes you pin out a zone where just one pullback make off of it, and then sometimes you tell you if you look out for multiple pullbacks. So you know for sure say one pullback is a zone and it's not just a move in the market.
All right, bro. Very good question. So if you realize, say, we could have draw one zone down here, so.
Right, yeah, and then now me
Okay.
I think me surprised you
All
have
right.
take a still because I think says a breaker structure and I'm gonna be looking for a buy because it
Okay.
break it passed that I'm say engulfing right there. So little bit after you, little bit before you,
So
the entry where you make, me see one engulfing bullish candle. So me confused.
so pretty this now, bro. First thing, remember, always keep in mind where is the market going. It's been going down, right? So you're biased towards sales. So no matter what going on, so you're not looking for no buys. The only way you should be taking buys on here is when time the market shift and look back like this. Do not be quick to take reversal trades in terms of say, yeah, go back in one buy direction. I know it might seem very attractive to enter the buy from way down the route, but don't try to be the first on the wave because the first on the wave normally lose. Enter the wave when time the wave certain. So I am certain that this is in our downtrend. And then the reason why me not end up with too much levels is my jaw the deeper levels them. Even right here, so could that be a level? Me never draw that because me know said this even if price did pull back to here and drop, me wouldn't catch it because my aim is not to catch everything. My aim is to catch trades that make sense within my formula. So this first level in my vocabulary because it's just too early, right? Either too far from point A up here. So cool. The only three levels where could have come into play for me is these three. Bam, bam, bam. See, even though price there the first one, yeah, price can push up and come to the second one. But that's why I see my stop loss a little bit above it, where if you come and touch it that much, me still safe, me still in a trade before me get stop out. Now, I know if me get stop out right now, me know say chances are one of two things that will happen. Is either price will go pull back to that deeper one up here so and then push down, or it will continue to go up. Either way, I can lose, but long term, me can't lose. If I say long term, I can't lose. If me enter the first trader, I may lose this. Let's say me lose $10. Cool. If me re-enter up here after getting the first loss, risking the same $10, and I win this trade, I would have made back the $10 I may lose plus $10 profit, which is $10 more than what I did have. So I still end up winning. If me lose a second entry, me lose $10 times 2, which is $20. Cool, man, I beat up myself. All me need is to win the next trade to make up back this winning trade. So every trade that back up each trade. So I know every trade that will equal money. Some trades are just there as lessons and it just did it to enforce this. Say, yo, every trade not gonna be a winning trade, but them still important because it's a step in the ladder. Make sense, bro?
Yeah, me see how you see that. And what me want to ask again too is so how far up you do a top-down analysis then? Because you say the market right now depend on a downtrend, but maybe if you look on a 4 hour, so you're going to say, see, look on that now. When I said this is an uptrend market, no.
No, bro. No.
I will just bounce off of that support.
Watch.
We look like a support.
Never try if you look too far back. The first thing. You see, over here, so was an uptrend, yes. And while this was important, over here, so we are dealing with now. So in my eyes, over here, so going so, it's important, but it's really important in me making a decision over here. Because we are dealing with current price movement, and the current price movement, bro, was this. Remember, think of price like one train. The price, a train and move in a one specific direction. You don't want to go against it. Make sense? So, but me understand your perspective, your perspective is on a bigger basis, on a bigger time frame. Overall, yes, it can be an uptrend, but remember, within every uptrend and downtrend, there is selling and buying still taking place. So in our uptrend, you may have small durations of sales. In our downtrend, you have small durations of buys. So maybe on the daily time frame or the weekly time frame, this might be in our overall uptrend. But when you break it down to the smaller time frame, like the 1 hour coming down, you have a definite downtrend. And remember, the type of trader where you be, I go heavily depend upon how you trade. What I mean by that is, if you are a scalper, You don't need for you look on the weekly and the big time frame there because it just don't make a difference. See?
Oh,
So I am a scalper. So me normally me I look on the current price movement because me know say me I catch a very small move. Me not try to catch a big thing one time. So because I'm catching this small thing right here, so it is safe to take my sales because me know say it's a small little downtrend. I take place right now, currently, and me I take part in that. Make sense?
yeah, yes.
So me
Depend on
understand your perspective, bro.
trader.
All
Yeah,
right, so the market actually come back to, you see, exactly, the market actually come back to, right back to the entry place. So we can take an entry right here, stop loss right up there. So let's see. Send the signal in the signals group.
So, bro, you don't feel like it's gonna take liquidity up at the top part and go back down.
Yeah,
Or point
anything
A.
can happen.
Feel like it's gonna
Anything,
go point A and come back down, isn't it? That's how me feel still, because it's
anything
right
can
now,
happen. Bro.
it a consolidate and it a go up. So I feel like it a go actually go up top, touch point 8, and then go take the liquidity there, then dip back down again.
Yeah, bro. So what I'm saying is anything can happen, right? But then I trade and think of what if. If I am seeing all my confirmations, I'm going to take my entry, regardless of my feelings.
Yeah.
So if me enter this and me lose, me know so me lose, me move on and move on again. So me not try to overcomplicate it or try to think about too much stuff because that is when you make a bag of mistake.
Yeah, true,
Understand?
yeah.
So while you may have a point and while that is a possibility, remember, we are dealing with taking risk. It's not gambling because we are work with a specific system. But anything can happen, bro.
Yeah, really.
Anything can happen.
The question, Legit.
Yeah, go ahead.
You see, I derivative X I use, I know,
No,
for the markup
I use charts.deriv.
charts that deriv. Cause I think them they phase out deriv X and so I have to use the C trader, but C trader kind of weird, you know.
Yeah, but I don't like it either.
Alright, so charts that deriv. Let me search it.
That's the one.
Respect. Somebody send in my chat.
So that's advantage trading charts and tools.
Yes, advanced charts and tools.
So question, you can trade on that currently like with your live account, or you have to just use your phone with MT5?
You have to use the phone with the MT5. Remember, MT5 is how you communicate with the trading account.
Yes. Okay.
All right.
Question, formula boss.
Yeah, go ahead.
First, love the work. What I ask is, how
Wanna
exactly
get
do you
break up there?
identify? Can you hear me better?
Yeah, me hear now.
Yeah. Question, how exactly do you identify a strong zone? Because a lot of times multiple zones are in the market, and you get indecisive and don't know which one. Because that's what happened to me. I mean, understand the whole basics and chain and all that, liquidity, everything, but the zones are always my problem. How do you identify a strong zone?
All right, so that's a very good question, bro. So basically, how we identify zones is one thing, whether it is strong or weak or whatever, the same concept. But try to look for the deepest levels. So you see the deepest levels in relation to where the push is starting from point A, those are the ones I am working with. So currently I'm working with this point A right here. So I know say this level and this level is the two most important one currently if the market should continue up, it would be this A and then this one up here. So these are the three levels where I am looking at. If price should go above these three levels, me know say me done. I done me done for right now. Because it means price can potentially change trend. Make sense?
Oh, so in other words, I look for the most impulsive zone, the one the price reacts the best, like
Yes.
offer.
Yes. But basically, bro. Basically.
I respect. Because I that I'm confused about most of the time. Because I get rest of concepts, all of that. Not a beginner because I do it for may I learn why I'm in a sixth form, but you know, I'm still have sometimes I'm confused because I'm still have some little pieces to put together.
Okay, I understand. All right. So by now, you guys should know, understand exactly how I came by this trade and everything. If you guys have further questions or still unclear on certain things, remember I have a free course. The link is in my bio. And I have also a free signals group, which this trade was also sent out in. So I'm now going to scan through to pick the winner for the giveaway. And remember, the winner must be following me, and the winner must also be following Deriv Caribbean Partners. So if I select you as a winner and you're not following the proper accounts, then that's a bummer. So I'm going to scan through. When I scan through, I'm going to let me see if I can message this person directly on the class, because I'm going to need your social media account so I can verify that you're following. So I'm going to see if I can message you guys directly on the class so you could send me your social media handle. All right. So here what? Everybody comment them Instagram page in the comment, and I'm going to just pick a random person, check if that person is following the pages, and if that person
Yeah,
qualifies,
man, for
then
me.
I will reach out to you and let you know that you're the winner. So here's how the winner and the giveaway is going to be structured. When the winner is selected, you will be basically picking the device that you want. So we are going to basically do a meetup at Quartz, and you pick the device that you want within a certain budget, right?
Okay.
So I am now going to, I see all the names flooding in. I see all the names flooding in. All the names are
And guys,
flooding
we
in.
want your email
But
address as
father, oh,
well.
you gonna pick it, father. That they are fly too much.
No, man, we can scroll back and select somebody randomly.
And we'll need your email address as well to confirm that you actually have a Deriv account so you can trade on Deriv. That is an option. So we'll do an official meetup in Kingston. If you're not in Kingston, that's okay. We will cover your fare, your transportation to get here, and you'll be able to select your device as the winner.
Okay, guys, I hope you hear that. So, Mr. The name them are flying, and remember to increase your chances, you can also send the name more than one time, just to make sure.
Formula boss. Which
It's
name of you? Instagram name or right name?
Instagram name.
Instagram
Okay.
name.
All right. Must up.
Look for the name them are flying.
Yo, bro.
Yeah, go ahead, man. I hear you.
Yeah. You see, let's say, I hear me.
Yeah, bro, man. I hear you.
Yeah, like how you have the markup there, so now the trader you currently mark off on the chart.
Yeah.
We notice we have some bullish engulfing, like in a little consolidation era. So you would have consider those. What you would have think about those engulfing?
So that is a very good question, and that occurs pretty much almost all the time. That is when context and the trend comes into play. So because I am in a downtrend, I know automatically to basically disregard the bullish engulfings because I am more focusing on what is current, which is we're in a downward trend. So I know say the bearish engulfing them go way more powerful than the bullish engulfings. Make sense?
Yeah, man, me understand. But
All
through
right.
more, one trade, I see that, you can kind of reconsider if it's a wise option or not.
Yeah, understand. All right, so I am in the process of
Yo, Formula boss.
yeah, bro. Go ahead.
I said, I wonder how you correlate the time frame. Like, see, you're marking up on 1 hour, then I drop to 5 minutes if you catch your entry, but that always a beat me. Can't get that properly.
All right, so basically, bro, time frame correlation takes time. Time frame correlation takes time to fully master. I don't think there is no one thing that I can say or do to make you completely understand it instantly. It takes time, it takes practice, and that is where your job come in. So after this class, you are required to actually, yeah, hear me, bro?
Yeah.
Yeah, so you are required to basically do your markups and do your practicing so you can basically make everything cement in your brain. So what you need to understand is if you're upon a 1 hour time frame, the lower time frame you go, the more noise I will get, the more candlesticks I will see. That simply means that you can refine your levels a lot more cleaner because you have got down to a more dense time frame. The bigger time frame will show you like a broader vision. The lower time frame will give you the small little movements, and you have to just know how to interpret it, right? So while the bigger time frame is more reliable, you use a smaller time frame for entry and if you actually tweak your levels them properly. Cool. All right, so I'm gonna search for the winner now. Bam, bam, bam. So one whole heap of name, one whole heap of people.
Hello.
Hello, go ahead. I'm hearing you.
Oh, okay. Good afternoon.
Good
I'm
afternoon.
just wondering, is because I have a derivative account since January, but I had somebody trade for me once. I'm wondering if there's any video out there that would assist in learning the steps of how to place a trade.
Yes. So in my free course, I go through how to enter a trade step by step. Everything is there.
Okay. All
So
right. Thank
use the
you.
link in my bio to join my free course.
Okay. All right. Thanks.
You're welcome.
Question to your formula.
Yes.
All right, so I'm be mentioned that you don't really so you basically trade say hit stop loss or TP, right? So my question is to you. All right, say you're in a trade and you're in some deep drawdown in profit. Would you advise person to move their stop loss in profit? Because sometimes as you know the market move in either direction and it move on its own, right? In the direction that it wants to go. Why not move in profit to avoid hitting stop loss or TP? So what's your take on that?
Yeah, bro. So once you're like 3/4 way in profits, it's safe to move your stop loss to break even. We know so you know come back and take back everything. So some of the time in the work out perfect because for instance, I may enter one trade and it might be at entry when time me I go sleep, so my stop loss now they in profits, and I might wake up and see price go almost to my TP and turn back. Like that happens a lot. You can't prevent it. You have to just know say it's just the hard facts of trading. So I've actually have somebody in mind for the winner. So for the persons who actually want to learn more about trading, because you guys, there's a lot more to the formula than this, and you guys should understand that everything can't be taught on this one class. To get further mentorship and further help, you can reach out to me to join my mentorship. Guys, remember, keep your microphones muted. Yeah, as I was saying, for persons who want to see more guidance and to get more mentorship, just send me a DM for information about mentorship program. And it's a one-on-one mentorship program. All right. So I'm going to proceed to reaching out to the winner so we can set up everything. All right. So persons are still commenting.
Pamela, quick query.
Yeah.
All right. So based on the trade you're just saying, I still I watch it, but like may have a sell 1, sell 0.3, sell 0.2. So as a scalper, you recommend having more than one position. So that way, if in profit,
What
we
again?
just as a scalper, right? Like we have 3
Yes.
positions. Currently in profit, now we have $4, right? We can just use one of them for just take profit and one for just go and run, or have you try them run? What's your perspective on that?
How much are you risking on this trade?
We have a 3 position, 1, and then we have a 0.3 and a 0.2. We have a $20 account right now.
Okay, so I mean, it all depends on you, bro. If you want to continue and make the position stay, you can close it. I can tell you directly what to do. You have to make that call based on what you know and what you've been learning so far. Make sense?
Okay. Makes sense.
Formula boss.
Yes.
Well, I appreciate everything. So let me learn a lot today. Yeah.
Yeah, man. So what you guys can do, so I'm actually will be doing 2 other giveaways. Right now, I'll be giving 2 persons 10K each. So what you need to do to qualify for that is to make a review video of the class so far. You need to post it on let's say your TikTok and your Instagram and tag me in it. And then from that, I will be selecting 2 more persons to be gifting. Either you can get access to my private signals group for 1 month, or you get 10K JMD. So after the class, you can make a review video, post it, tag me in it, and you stand a chance to also win a prize. So it's not just the one person will be walking away today with a blessing. 2 more persons will be selected. Once I just make a review video, post it on TikTok and Instagram.
So Formula boss, some of the video the class we just learn and then post it on my Instagram.
You can be creative. You can make a POV style video. You can video the class. You can do anything you want. As long as it's like a review, like a honest review of the class so far.
All right.
All right. So I'll be keeping you guys updated on this trade right now. I will send an update in the same group, so you can stay tuned to that. And I'll also be compiling the recording to send in the group as well, so you guys can also rewatch it. All right. So I hope everybody have a great weekend and stay safe, y'all.
Respect, man, brother. Big up yourself too, man. No love.
Respect
One
again.
Formula
Take care.
man.
Thank you.
Respect, Formula.
One
Big
love.
up Formula man. Believe Formula.
Bless up,
Believe.
yo.
Up, big up, Formula. Up.
Yeah.
One Formula boss.
Never
No
too.
boy, man.
Right.
Yeah.
Thank you. It was a pleasure to join. I learned a
Big
lot
up,
today.
big up.
Thank you.
So they now give me the winnings.
Me there they say I'm not getting message yet.
How we gonna win?
Formula boss. Nothing did it. Formula. I'm gone. You don't want to ask him something still in that over going in class. That one when VIPs.
What
Yo,
that the
just
free telegram?
go, yo, just go on him
Eh?
page and go in a bio. You go see what link tree you can join from the
Check the Instagram page. Him have a link
All
tree
right.
Or
with
TikTok.
and TikTok, yeah.
Yeah,
yeah,
yeah, my
but
page. Yeah, my page. Bro.
Instagram I verify one. You have to
Yeah,
look
yeah.
for KBS came
Respect.
out.
Respect.
Yeah.
Me and say for you.
That one.
Come on, if you want, and better. So I call you, I go come on to the farm and what we can do, we can do. Guys, I really want to see some music. So that you don't want me to do it.
You need to do it, man.
But man, saying, man, Lord, yeah, no, party, and then one. Now, too much things, and it's complicated. And the man is something simple to me, dog, and it's easy to have a simple. This is the simple thing. You know something. Yeah, brother, the simple thing, brother, we do. You know, the people them listening to the thing, dog, right now.
Yeah, I
Family boss a real deal. Let's see it, people. No joke. Real teacher. Big up yourself, family boss. It's an excellent sell that we get also today. Family boss fan a sell and give all of us. I'm enter that sell also. Peeps, let's see it. Yeah man, big up on yourself. Everybody there on the line.
Yeah, man, cool. Yeah.
Make it 29, man. Random dial them book as color all the time. What if Friday morning and one? Only not a Friday me out play. Only not a Friday ring. The man them they were serious. The man them they were serious. Yeah, Joker smoke a trade day in this man. I'm not ready for the trade. Remember the money every killer face. Bitcoin put the money upside down. Me a type on the phone. Take sales for the Saints get. Oh yeah. Oh yeah. Alright. Grab it line there. What a sacrifice time. Alright, man. I show them a strategy. Alright. See like, oh, I can't share. Look, I'm going to go on a piece of sauce. I see it. I late still. So no. Real trader. No joke or smoke.
You.